Question 1. John is a resident of Nebraska and wants to purchase a long-term care insurance policy. He is concerned about the potential for premium increases in the future. Which of the following statements is most accurate regarding premium increases for long-term care insurance policies in Nebraska? A. Premiums for long-term care insurance policies in Nebraska can increase without any restrictions. B. Nebraska law prohibits any premium increases for long-term care insurance policies after they are issued. C. Insurers offering long-term care insurance in Nebraska must offer guaranteed renewable policies with level premiums. D. Nebraska follows a community rating system for long-term care insurance, meaning premiums can only increase for the entire policyholder group. The correct answer is D. Nebraska follows a community rating system for long-term care insurance, meaning premiums can only increase for the entire policyholder group. Nebraska follows a community rating system for long-term care insurance. This means that premium increases for a specific policy can occur, but they must apply to the entire group of policyholders with the same coverage in the same geographic area. This prevents insurers from unfairly targeting individual policyholders for premium hikes. Reference: Nebraska Department of Insurance, Long-Term Care Insurance Guide. Question 2. Mary is a licensed life insurance agent in Nebraska and is explaining disability income insurance to a client. The client asks about the difference between an own occupation disability benefit and an any occupation disability benefit. Which of the following is the best explanation for Mary to provide? A. Own occupation benefits are only paid if the disability prevents you from working in any occupation. B. Any occupation benefits are only paid if you are completely unable to work in any capacity. C. Own occupation benefits are paid if you are unable to perform the substantial and material duties of your regular occupation, even if you can work in another field. D. Any occupation benefits are more expensive than own occupation benefits because they offer a wider range of coverage. The correct answer is C. Own occupation benefits are paid if you are unable to perform the substantial and material duties of your regular occupation, even if you can work in another field. Disability income insurance benefits can be classified as own occupation or any occupation. Own occupation benefits provide a safety net if a disability prevents you from working in your specific occupation, even if you could perform the duties of another job. This offers a higher level of protection but typically comes with a higher premium. Any occupation benefits, on the other hand, only pay out if you are completely unable to work in any capacity, regardless of the occupation. Reference: National Association of Insurance Commissioners, Disability Income Insurance. Question 3. A health insurance company operating in Nebraska is developing a new health insurance plan that excludes coverage for certain mental health conditions. Is this practice allowed under Nebraska law? A. Yes. Health insurance companies in Nebraska have complete discretion over what mental health services they cover. B. No. Nebraska follows strict mental health parity laws, requiring health insurance plans to cover mental health conditions on par with physical health conditions. C. Maybe. Nebraska allows for some exclusions as long as the exclusions are clearly outlined in the policy and meet certain criteria. D. It depends on the type of health insurance plan. Employer-sponsored plans have more flexibility in excluding mental health coverage compared to individual plans. The correct answer is B. No. Nebraska follows strict mental health parity laws, requiring health insurance plans to cover mental health conditions on par with physical health conditions. Nebraska has adopted mental health parity laws that require health insurance companies to provide coverage for mental health conditions that is substantially equivalent to the coverage for physical health conditions. This means that health plans cannot deny coverage, place higher deductibles or copayments, or impose stricter limitations on mental health services compared to medical services. Reference: Nebraska Department of Insurance, Mental Health Parity and Addiction Equity Laws. Question 4. During the enrollment process for a new individual health insurance policy in Nebraska, Sarah is asked to answer health questions. She has a pre-existing condition but is concerned about being denied coverage or facing higher premiums due to this condition. What are Sarah's rights under Nebraska's health insurance reforms? A. Sarah cannot be denied coverage based on a pre-existing condition, but insurers can charge her a higher premium. B. Nebraska allows insurers to deny coverage or charge higher premiums based on pre-existing conditions. C. Sarah can choose not to disclose her pre-existing condition, but the insurer can deny coverage if they discover it later. D. Nebraska requires insurers to offer guaranteed issue policies, meaning they cannot deny coverage or charge higher premiums based on health status. The correct answer is A. Sarah cannot be denied coverage based on a pre-existing condition, but insurers can charge her a higher premium. Nebraska has implemented reforms that prohibit health insurance companies from denying coverage or charging higher premiums based solely on pre-existing conditions. However, insurers can still vary premiums based on factors like age, tobacco use, and geographic location. Reference: Nebraska Department of Insurance, Individual Health Insurance Marketplace. Question 5. David is a life insurance agent licensed in Nebraska and is presenting a universal life insurance policy to a client. The client asks about the difference between the guaranteed death benefit and the cash value component of the policy. How should David explain this difference? A. The guaranteed death benefit is a fixed amount paid out upon the policyholder's death, while the cash value is a variable amount that accumulates over time and can be withdrawn or borrowed against. B. Both the guaranteed death benefit and the cash value grow at a fixed interest rate and are paid out to the beneficiary upon the policyholder's death. C. The cash value component is the guaranteed payout upon death, and the guaranteed death benefit is a bonus amount paid on top of the cash value. D. Universal life insurance only offers a guaranteed death benefit, and there is no cash value component. The correct answer is A. The guaranteed death benefit is a fixed amount paid out upon the policyholder's death, while the cash value is a variable amount that accumulates over time and can be withdrawn or borrowed against. Universal life insurance offers two key features: guaranteed death benefit. This is a fixed amount paid to the beneficiary upon the policyholder's death. The death benefit amount is stated in the policy contract and remains guaranteed regardless of the policy's cash value. Cash value. This is an account within the policy that accumulates value over time. Premiums paid into the policy, minus any charges or withdrawals, contribute to the cash value. The policyholder can access the cash value through withdrawals or loans. Reference: National Association of Insurance Commissioners, Universal Life Insurance. Question 6. A group health insurance policy issued in Nebraska excludes coverage for prescription drugs. Is this exclusion allowed under the state's health insurance regulations? A. Yes. Group health plans in Nebraska have more flexibility in excluding benefits compared to individual plans. B. No. Nebraska mandates that all health insurance plans, including group plans, must cover prescription drugs. C. The exclusion is allowed only if the employer offers a separate prescription drug plan to employees. D. It depends on the size of the employer group. Smaller employer groups have more leeway in excluding benefits. The correct answer is A. Yes, group health plans in Nebraska have more flexibility in excluding benefits compared to individual plans. Generally, group health plans in Nebraska have more flexibility in designing their coverage compared to individual health insurance plans. This means they can potentially exclude certain benefits, such as prescription drugs. However, employers should be transparent about the plan's exclusions and limitations in the plan documents. Reference: Nebraska Department of Labor, Group Health Plans. Question 7. Lisa is a resident of Nebraska considering a Medicare supplement policy, Medigap. She understands that Medigap plans help cover out-of-pocket costs associated with original Medicare. Lisa asks about the process for replacing her current Medigap plan with a different one. What is the agent's best response regarding Medigap plan replacement in Nebraska? A. Lisa can replace her Medigap plan at any time without restrictions. B. Nebraska follows a guaranteed replacement provision, allowing Lisa to switch plans during specific enrollment windows regardless of her health status. C. Replacing a Medigap plan in Nebraska requires medical underwriting, meaning the new insurer may deny coverage based on pre-existing conditions. D. Lisa cannot replace her current Medigap plan unless she loses her current coverage or experiences a significant life event like marriage or job loss. The correct answer is B. Nebraska follows a guaranteed replacement provision, allowing Lisa to switch plans during specific enrollment windows regardless of her health status. Nebraska adheres to federal Medigap regulations, which include guaranteed replacement provisions. This allows Lisa to switch to a different Medigap plan during designated enrollment windows, even if her health has declined. However, these enrollment periods may be limited, so it's crucial to understand the specific windows for her situation. Reference: Medicare.gov, Medigap plans. Choose a plan. Question 8. An agent is explaining accident insurance to a potential client in Nebraska. The client inquires about the difference between accident insurance and disability income insurance. How should the agent distinguish between these two coverages? A. Accident insurance only covers benefits for accidental injuries, while disability income insurance covers any disability, accidental or illness-related. B. Both accident insurance and disability income insurance offer income replacement benefits in case of disability, but accident insurance typically provides a lump sum payout, while disability income insurance pays benefits over time. C. Accident insurance covers medical expenses resulting from accidents, whereas disability income insurance provides income replacement if an accident or illness prevents work. D. There is no significant difference. Both accident insurance and disability income insurance offer similar benefits. The correct answer is A. Accident insurance only covers benefits for accidental injuries, while disability income insurance covers any disability, accidental or illness-related. Accident insurance and disability income insurance address different needs. Accident insurance. This type of insurance provides a financial benefit if the policyholder suffers an accidental injury, often as a lump sum payout. The benefits may help cover medical bills, lost wages during recovery, or other expenses. Disability income insurance. This insurance replaces a portion of the policyholder's income if they are unable to work due to a disability, regardless of whether the disability is caused by an accident or illness. Benefits are typically paid out monthly over a defined period. Reference: National Association of Insurance Commissioners, Accident Insurance. Question 9. During a conversation about life insurance options, a client in Nebraska asks the agent about the concept of a contestability period. How should the agent explain this concept? A. The contestability period is the time frame after policy issuance where the insurer can cancel the policy if they discover inaccurate information on the application. B. It's the period during which the policyholder can make changes to the beneficiary designation without penalty. C. The contestability period allows the beneficiary to contest the payout of the death benefit if they believe they are not the rightful recipient. D. There is no contestability period in life insurance policies issued in Nebraska. The correct answer is A. The contestability period is the time frame after policy issuance where the insurer can cancel the policy if they discover inaccurate information on the application. The contestability period is a clause included in most life insurance policies. It grants the insurer a specific time frame, typically 1 to 2 years, after the policy's issuance to investigate the accuracy of information provided on the application. If the insurer discovers material misrepresentations on the application during this period, they may have the right to rescind the policy and deny the death benefit. Reference: Insurance Information Institute, Life Insurance Basics. Question 10. During the application process for a long-term care insurance policy in Nebraska, Michael is asked to complete a cognitive assessment. Why might a long-term care insurer require such an assessment? A. To evaluate Michael's financial situation and ability to afford premiums. B. To assess Michael's understanding of the policy benefits and limitations. C. To determine Michael's cognitive function and potential future need for long-term care services. D. Cognitive assessments are not required for long-term care insurance applications in Nebraska. The correct answer is C. To determine Michael's cognitive function and potential future need for long-term care services. Long-term care insurers may require a cognitive assessment as part of the underwriting process. This assessment helps evaluate an applicant's cognitive function and memory. The goal is to assess the applicant's potential future need for long-term care services due to cognitive decline. Reference: National Association of Insurance Commissioners, Long-Term Care Insurance. Question 11. An agent is explaining critical illness insurance to a client in Nebraska. The client inquires about the difference between a critical illness rider attached to a life insurance policy and a standalone critical illness insurance policy. How should the agent distinguish between these two options? A. A critical illness rider offers a lump sum payout upon diagnosis of a covered critical illness, while a standalone policy provides income replacement benefits. B. Standalone critical illness insurance requires a separate medical underwriting process, whereas a rider attached to life insurance leverages the existing life insurance underwriting. C. There is no significant difference. Both options provide a financial benefit upon diagnosis of a critical illness. D. Critical illness riders offer coverage for a broader range of critical illnesses compared to standalone critical illness insurance policies. The correct answer is B. Standalone critical illness insurance requires a separate medical underwriting process, whereas a rider attached to life insurance leverages the existing life insurance underwriting. Critical illness rider. This is an optional add-on benefit that can be attached to a life insurance policy. It pays a lump sum benefit upon diagnosis of a covered critical illness, helping with immediate financial needs. The underwriting process for the rider typically considers the existing life insurance policy underwriting. Standalone critical illness insurance. This is a separate insurance policy specifically designed to provide a financial benefit upon diagnosis of a critical illness. The benefit may be a lump sum payout or income replacement over a specific period. Standalone policies typically require a separate medical underwriting process. Reference: LIMRA, Critical Illness Insurance. Question 12. A health insurance company operating in Nebraska is developing a new health insurance plan. The plan offers a tiered network of providers, with lower premiums for using in-network providers. Is this practice allowed under Nebraska insurance regulations? A. No. Nebraska prohibits health insurance plans from offering tiered networks based on provider participation. B. Tiered networks are allowed, but the insurer must ensure all essential health benefits are accessible within the network. C. Tiered networks are only allowed for employer-sponsored plans, not individual health insurance plans. D. Yes. Tiered networks are a common practice in health insurance, and there are no specific restrictions in Nebraska. The correct answer is B. Tiered networks are allowed, but the insurer must ensure all essential health benefits are accessible within the network. Tiered networks are a common approach in health insurance plans, and Nebraska allows them. However, insurers offering tiered networks must ensure that all essential health benefits mandated under the Affordable Care Act, ACA, are accessible within the network. This means there should be a sufficient number of qualified providers within the network to deliver these essential services. Reference: Nebraska Department of Insurance, Individual Health Insurance Marketplace. Question 13. During an appointment with a potential client in Nebraska, a life insurance agent discusses policy replacement. The client currently has a whole life policy but is interested in exploring term life insurance options. What factors should the agent consider when discussing policy replacement with the client? A. The client's age and need for permanent life insurance coverage. B. The surrender charges associated with canceling the existing whole life policy. C. Both A and B. D. Neither A nor B. The correct answer is C. Both A and B. Policy replacement is a significant decision, and the agent should discuss several factors with the client before recommending it. Here are 2 key points to consider. Client's age and needs. Whole life insurance offers permanent coverage with a cash value component. Term life insurance provides temporary coverage at a lower premium. The client's age and need for permanent coverage versus affordability of term life should be considered. Surrender charges. Canceling a whole life policy before it accumulates significant cash value may result in surrender charges. The agent should explain these charges and their impact on the overall financial picture. Reference: National Association of Insurance Commissioners, Replacing Life Insurance. Question 14. A health insurance company in Nebraska receives a complaint from a policyholder who was denied coverage for a specific mental health treatment. What Nebraska law or regulation would most likely be relevant in addressing this complaint? A. Nebraska Department of Labor grievance procedures, for employer-sponsored plans only. B. Medicare guidelines, if the policyholder is a Medicare beneficiary. C. Nebraska's mental health parity and addiction equity laws. D. Fair Credit Reporting Act, for situations involving credit checks during underwriting. The correct answer is C. Nebraska's mental health parity and addiction equity laws. Nebraska's mental health parity and addiction equity laws mandate that health insurance companies provide coverage for mental health conditions that is substantially equivalent to the coverage for physical health conditions. If a policyholder is denied coverage for a mental health treatment that would be covered for a physical condition, this law would be the most relevant in addressing the complaint. Reference: Nebraska Department of Insurance, Mental Health Parity and Addiction Equity Laws. Question 15. An agent is explaining Medicare Advantage plans, Part C, to a potential client in Nebraska. The client inquires about the network of providers available under a Medicare Advantage plan. How should the agent respond regarding provider networks in Medicare Advantage plans? A. Medicare Advantage plans offer the same network of providers as original Medicare, Parts A and B. B. Medicare Advantage plans can have different provider networks, and the client should carefully review the specific plan's network details. C. All Medicare Advantage plans in Nebraska are required to offer a nationwide network of providers. D. The client can choose any provider who accepts Medicare for their services, regardless of the Medicare Advantage plan they select. The correct answer is B. Medicare Advantage plans can have different provider networks, and the client should carefully review the specific plan's network details. Medicare Advantage plans, Part C, are offered by private insurance companies and provide an alternative way to receive Medicare benefits. Unlike original Medicare, Medicare Advantage plans typically have specific provider networks. The agent should explain that the client needs to review the specific plan details to understand the network of doctors, hospitals, and other healthcare providers covered under the plan. Reference: Medicare.gov, Medicare Advantage plans. Question 16. During a presentation on disability income insurance, an agent is explaining benefit periods. A client asks, "What factors should I consider when choosing a benefit period for my disability income insurance policy?" How should the agent respond? A. The benefit period should be long enough to cover your mortgage and other debts. B. The ideal benefit period depends on your occupation and the likelihood of returning to work after a disability. C. A longer benefit period will always be better, regardless of your circumstances. D. The best approach is to choose the shortest benefit period to minimize premium costs. The correct answer is B. The ideal benefit period depends on your occupation and the likelihood of returning to work after a disability. The ideal benefit period for disability income insurance depends on individual circumstances. Here are some factors to consider. Occupation. Some occupations have a higher likelihood of permanent disability compared to others. Choosing a longer benefit period might be prudent for someone in a high-risk profession. Financial needs. Consider your essential expenses and how long it might take to recover financially if you become disabled. Retirement age. You may want the benefit period to extend until you reach retirement age if you plan to rely on disability income as a replacement for your regular income. Reference: National Association of Insurance Commissioners. Disability Income Insurance. Question 17. A life insurance agent in Nebraska is contacted by a potential client, Sarah, who wants to purchase a life insurance policy. Sarah has a pre-existing medical condition. What information can the agent ethically disclose to Sarah regarding life insurance options in Nebraska? A. The agent cannot disclose any information about life insurance options until a formal application is submitted. B. The agent can explain that Sarah will likely be denied coverage due to her pre-existing condition. C. The agent can inform Sarah about Nebraska's guaranteed issue laws for life insurance, allowing her to obtain coverage regardless of health status. D. The agent can discuss various life insurance options and explain how pre-existing conditions may affect the premium amount or underwriting decision. The correct answer is D. The agent can discuss various life insurance options and explain how pre-existing conditions may affect the premium amount or underwriting decision. Nebraska does not have guaranteed issue laws for life insurance. However, the agent can ethically discuss various life insurance options available and explain how pre-existing conditions might impact the underwriting process. This may involve higher premiums, exclusions, or even denial of coverage depending on the severity of the condition. Reference: Nebraska Department of Insurance, Life Insurance. Question 18. An agent is explaining Medicare Supplement Insurance, Medigap, plans to a client in Nebraska. The client asks, "Can I be dropped from my Medigap plan if my health condition worsens?" How should the agent respond? A. Yes, Medigap plans can cancel coverage if a policyholder's health deteriorates. B. Medigap plans are guaranteed renewable, meaning they cannot be canceled by the insurer due to health changes. C. The plan can be canceled only if the policyholder fails to pay premiums. D. Medigap plans can be non-renewed under specific circumstances, but not solely due to a worsening health condition. The correct answer is B. Medigap plans are guaranteed renewable, meaning they cannot be canceled by the insurer due to health changes. Medigap plans in Nebraska are guaranteed renewable. This means the insurer cannot cancel the policy or increase premiums due to a policyholder's health changes. However, the client should be aware that premiums may increase for the entire policyholder group based on factors like age and claims experience. Reference: Medicare.gov, Medigap plans. Choose a plan. Question 19. An insurance company in Nebraska is developing a new short-term health insurance plan. What are some of the key limitations to consider when explaining short-term health insurance plans to clients? A. Short-term health plans cannot cover pre-existing conditions. B. Short-term health plans typically have annual or lifetime maximum benefit limits. C. Both A and B are limitations of short-term health plans. D. Short-term health plans offer comprehensive coverage similar to traditional health insurance plans. The correct answer is C. Both A and B are limitations of short-term health plans. Short-term health insurance plans offer temporary medical coverage, typically lasting for a period of a few months up to a year. However, they come with limitations compared to traditional health insurance plans. Pre-existing conditions. Short-term health plans generally do not cover pre-existing medical conditions. Benefit limits. These plans often have annual or lifetime maximum benefit limits, capping the total amount the insurer will pay for covered medical expenses during a specific period. Reference: Centers for Medicare and Medicaid Services, short-term, limited-duration health insurance. Question 20. A health insurance agent is contacted by a client who is concerned about the high cost of their individual health insurance plan in Nebraska. The client asks if there are any government subsidies available to help them afford coverage. What is the best response from the agent? A. The agent cannot provide information about government subsidies and should recommend contacting a government agency. B. The agent can explain the availability of the federal marketplace, ACA marketplace, where clients may qualify for premium subsidies based on income. C. Advise the client to look for employer-sponsored plans, which typically offer lower premiums. D. Government subsidies are not available for individual health insurance plans in Nebraska. The correct answer is B. The agent can explain the availability of the federal marketplace, ACA marketplace, where clients may qualify for premium subsidies based on income. The Affordable Care Act, ACA, established the Health Insurance Marketplace, a platform where individuals can compare and enroll in health insurance plans. Clients with qualifying income levels may be eligible for premium subsidies that help lower the monthly cost of their coverage. Reference: healthcare.gov, Health Insurance Marketplace. Question 21. An agent is explaining long-term care insurance options to a client in Nebraska. The client inquires about tax advantages associated with long-term care insurance. How should the agent respond? A. Long-term care insurance premiums are always tax-deductible in Nebraska. B. Tax benefits for long-term care insurance may vary depending on the client's tax situation and federal tax code changes. C. There are no tax advantages associated with long-term care insurance in Nebraska. D. Clients can deduct the entire cost of long-term care benefits received from their taxes. The correct answer is B. Tax benefits for long-term care insurance may vary depending on the client's tax situation and federal tax code changes. Tax benefits for long-term care insurance can vary depending on several factors, including federal tax code changes. Tax deductions for long-term care premiums may be subject to change based on federal tax law. Client's tax situation. The client's income level and tax filing status may determine the extent to which they can benefit from tax deductions. The agent should recommend the client consult with a tax advisor to understand the specific tax implications of long-term care insurance in their situation. Reference: Internal Revenue Service, Publication 502, Medical and Dental Expenses. Question 22. During a meeting with a potential client interested in critical illness insurance, an agent discusses the concept of a graded benefit. How should the agent explain a graded benefit in critical illness insurance? A. A graded benefit offers a higher payout for certain critical illnesses compared to others. B. The benefit amount increases over time as the policy remains in force. C. Premiums are lower during the initial years of the policy with a graded benefit. D. A graded benefit pays a reduced benefit amount if the critical illness is diagnosed within a specific period after policy issuance. The correct answer is D. A graded benefit pays a reduced benefit amount if the critical illness is diagnosed within a specific period after policy issuance. Some critical illness insurance policies may include a graded benefit provision. This means that the full death benefit is not paid out immediately if a covered critical illness is diagnosed within a certain period, typically 1 to 2 years, after policy issuance. Instead, a reduced benefit amount is paid during this initial period. Reference: National Association of Insurance Commissioners, Critical Illness Insurance. Question 23. An agent is explaining disability income insurance to a client in Nebraska. The client asks, "What happens to my disability income insurance policy if I return to work after a disability?" A. The policy is automatically canceled once the disability benefits are exhausted. B. The coverage remains in effect, but the client may need to go through a new medical underwriting process if they want to resume benefits in the future. C. The client can keep the policy and continue paying premiums, with benefits resuming if they become disabled again. D. The client has the option to convert the disability income insurance policy to a long-term care insurance policy. The correct answer is C. The client can keep the policy and continue paying premiums, with benefits resuming if they become disabled again. Disability income insurance provides income replacement benefits if the policyholder becomes disabled and unable to work. If the client recovers and returns to work, they can typically keep the policy and continue paying premiums. The coverage remains in effect, and benefits would resume if they become disabled again in the future, subject to the policy provisions. Reference: National Association of Insurance Commissioners. Disability Income Insurance. Question 24. A health insurance company in Nebraska receives a complaint from a policyholder who believes they were unfairly denied coverage for a specific service. What is the most likely course of action for the policyholder in this situation? A. File a complaint with the agent who sold them the policy. B. Contact the health insurance marketplace where they purchased the plan, if applicable. C. File an appeal with the health insurance company itself. D. Sue the health insurance company in court. The correct answer is C. File an appeal with the health insurance company itself. The first step for the policyholder who disagrees with a coverage denial should be to file an appeal with the health insurance company itself. Most insurance companies have internal appeal processes for handling such grievances. Reference: Nebraska Department of Insurance, Consumer Resources. Question 25. An agent is meeting with a young client who recently graduated from college and is looking for health insurance options in Nebraska. The client is currently unemployed but expects to find a job with employer-sponsored health insurance within a few months. What are some of the health insurance options the agent can discuss with the client? A. COBRA continuation coverage, if previously covered under a parent's plan. B. Short-term health insurance plan. C. Individual health insurance plan on the healthcare.gov marketplace. D. All of the above. The correct answer is D. All of the above. The young client has several health insurance options to consider in Nebraska. COBRA continuation coverage. If the client was previously covered under a parent's health insurance plan, they may be eligible for COBRA continuation coverage. This allows them to temporarily continue coverage under the parent's plan for a limited period, typically 18 months, but they will need to pay the full premium cost. Short-term health insurance plan. Short-term health plans offer temporary medical coverage, which can be helpful for a few months until the client finds a job with employer-sponsored insurance. However, these plans have limitations, such as not covering pre-existing conditions and having annual or lifetime maximum benefit limits. Individual health insurance plan on the healthcare.gov marketplace. The client can explore enrolling in an individual health insurance plan through the healthcare.gov marketplace. Depending on their income level, they may qualify for premium subsidies to help lower the monthly cost of coverage. Reference: Centers for Medicare and Medicaid Services. COBRA continuation coverage. Centers for Medicare and Medicaid Services. Short-term, limited duration health insurance. Healthcare.gov, Health Insurance Marketplace. Question 26. A life insurance agent is contacted by a client who wants to cancel their current life insurance policy and purchase a new one. What are some important considerations the agent should discuss with the client before moving forward? A. The potential surrender charges associated with canceling the existing policy. B. Whether the client's health status has changed since the original policy was issued, which could affect the new policy's underwriting. C. Both A and B are important considerations. D. There is no need to discuss these points. The client can simply cancel the old policy and apply for a new one. The correct answer is C. Both A and B are important considerations. Canceling an existing life insurance policy and purchasing a new one can have financial implications. The agent should discuss these important considerations with the client. Surrender charges. Canceling a policy before it accumulates significant cash value may result in surrender charges. These charges can be a significant portion of the premiums paid, especially for newer policies. Changes in health. The client's health status since the original policy was issued could affect the underwriting process for the new policy. Depending on the severity of any changes, they may face higher premiums or even denial of coverage. Reference: National Association of Insurance Commissioners, Replacing Life Insurance. Question 27. A client inquires about accident insurance while renewing their auto insurance policy. How does accident insurance differ from auto medical payments coverage, MedPay? A. Accident insurance provides benefits for any accidental injury, regardless of the cause, while MedPay is limited to car accident injuries. B. MedPay covers medical expenses resulting from an accident, whereas accident insurance offers cash benefits. C. There is no significant difference. Both accident insurance and MedPay offer similar benefits. D. Accident insurance is typically more expensive than MedPay coverage. The correct answer is B. MedPay covers medical expenses resulting from an accident, whereas accident insurance offers cash benefits. Here's a breakdown of the key differences between accident insurance and auto medical payments coverage, MedPay. Accident insurance. This type of insurance provides a financial benefit, lump sum payout or disability income, if the policyholder suffers an accidental injury, regardless of the cause, car accident, slip and fall, etc. Auto medical payments coverage, MedPay. This is an optional add-on coverage for auto insurance policies. It helps cover medical expenses incurred by the policyholder and their passengers due to injuries sustained in a car accident, regardless of fault. Question 28. A group health insurance policyholder in Nebraska contacts their agent because they are expecting a baby. What is the most relevant question the agent should ask the client in this situation? A. Does the policy cover maternity services? B. When is the baby's due date? C. Will the new child be added to the policy? D. All of the above are relevant questions. The correct answer is D. All of the above are relevant questions. The arrival of a new child can impact the group health insurance policy. Here are some relevant questions the agent should ask the client. Does the policy cover maternity services? Understanding the policy's coverage for maternity services, including prenatal care, labor and delivery, and postnatal care, is crucial. When is the baby's due date? Knowing the due date helps determine if the newborn can be enrolled within the timeframe allowed by the policy for adding dependents. Will the new child be added to the policy? Group health insurance plans typically allow adding new dependents within a specific window after birth or adoption. The agent can explain the process and any associated costs for adding the child to the coverage. Reference: National Association of Health Underwriters, Group Benefits for Employers. Question 29. An agent is explaining Medicare Part D, prescription drug coverage, to a client in Nebraska. The client inquires about the coverage gap, also known as the donut hole. How should the agent explain the coverage gap in Medicare Part D? A. The donut hole is a period where Medicare stops paying benefits altogether for covered prescription drugs. B. Once the beneficiary reaches the coverage gap, they are responsible for the full cost of their medications. C. The donut hole refers to the difference between the deductible and the out-of-pocket maximum in Medicare Part D. The coverage gap is a phase where beneficiaries pay a reduced percentage of the cost for their prescriptions. The correct answer is B. Once the beneficiary reaches the coverage gap, they are responsible for the full cost of their medications. Medicare Part D has a coverage gap, also known as the donut hole. This is a period after the beneficiary reaches the initial coverage stage and before reaching catastrophic coverage. During the donut hole, the beneficiary is responsible for a higher share of the cost for their covered prescription drugs. Reference: Medicare.gov, Medicare Part D, prescription drug coverage. Question 30. A life insurance agent is contacted by a potential client interested in purchasing a universal life insurance policy. What are some key features of universal life insurance that the agent should explain to the client? A. Universal life insurance offers guaranteed death benefit and a cash value component that grows at a fixed interest rate. B. Premiums for universal life insurance are typically fixed throughout the policy term. C. Policyholders have some flexibility with premium payments and the death benefit amount with universal life insurance. D. Universal life insurance is a form of term life insurance with a permanent death benefit. The correct answer is C. Policyholders have some flexibility with premium payments and the death benefit amount with universal life insurance. Universal life insurance is a type of permanent life insurance that combines death benefit protection with a cash value savings component. Here are some key features to explain to the client. Flexible premiums. Unlike whole life insurance with fixed premiums, universal life often allows for some flexibility in premium payments. Policyholders may be able to adjust premium amounts within certain limits. Adjustable death benefit. Within limits, some universal life policies allow the policyholder to adjust the death benefit amount to meet changing needs. Cash value accumulation. The policy accumulates cash value over time, which can grow at a fixed or indexed interest rate. The policyholder may be able to borrow against the cash value or withdraw funds for various purposes. Reference: National Association of Insurance Commissioners, Universal Life Insurance. Question 31. A health insurance company in Nebraska is developing a new dental insurance plan. What are some common benefits typically included in dental insurance plans? A. Preventive care. Cleanings, exams, X-rays. B. Basic restorative procedures, fillings, crowns. C. Major dental procedures, oral surgery, dentures. D. All of the above are common benefits in dental insurance plans. The correct answer is D. All of the above are common benefits in dental insurance plans. Dental insurance plans typically offer a combination of benefits across different categories. Preventive care. This covers routine dental checkups, cleanings, and X-rays, helping to prevent future problems. Basic restorative procedures. These cover procedures such as fillings, crowns, and root canals to repair damaged teeth. Major dental procedures. Some plans may cover a portion of the cost for more complex procedures like oral surgery, dentures, or orthodontics. Reference: National Association of Dental Plans, Dental Insurance 101. Question 32. An agent is meeting with a client who wants to increase their life insurance coverage. The client is concerned about the cost of a new policy. What are some factors that can affect the cost of life insurance premiums? A. Age, health status, and lifestyle habits, smoking, risky hobbies. B. Type of life insurance, term versus whole life. C. Desired death benefit amount. D. All of the above factors can affect life insurance premiums. The correct answer is D. All of the above factors can affect life insurance premiums. Several factors influence life insurance premiums. Here are some key points to consider. Client's age. Generally, younger applicants pay lower premiums compared to older applicants. Health status. Pre-existing health conditions or high-risk behaviors like smoking can lead to higher premiums or even denial of coverage. Life insurance type. Term life insurance typically has lower premiums compared to permanent life insurance products like whole life, which offer a cash value component. Desired death benefit amount. The higher the death benefit, the more the premium will cost. Reference: National Association of Insurance Commissioners, Life Insurance Basics. Question 33. A health insurance company in Nebraska receives a complaint alleging that an agent misrepresented the benefits of a particular health insurance plan. What is the most appropriate course of action for the insurance company? A. Ignore the complaint unless the client can provide written documentation. B. Investigate the complaint to determine if there is any validity to the allegations. C. Terminate the agent's contract immediately if the client seems dissatisfied. D. Advise the client to file a complaint with the Nebraska Department of Insurance. The correct answer is B. Investigate the complaint to determine if there is any validity to the allegations. When a policyholder complains about potential misrepresentation of benefits by an agent, the insurance company has a responsibility to investigate the complaint. This may involve reviewing the agent's communications with the client and the plan details. Reference: National Association of Insurance Commissioners, Producer Licensing. Question 34. A client inquires about long-term care insurance during a meeting with a life insurance agent. The client asks, "What are some advantages of purchasing long-term care insurance while I am still young and healthy?" A. Premiums are typically lower for younger and healthier applicants. B. Guaranteed acceptance into the long-term care insurance plan, regardless of future health conditions. C. Wider range of plan options and benefits may be available to younger applicants. D. All of the above are advantages of purchasing long-term care insurance at a younger age. The correct answer is D. All of the above are advantages of purchasing long-term care insurance at a younger age. There are several advantages to considering long-term care insurance earlier in life. Lower premiums. Younger applicants with good health typically qualify for lower premiums compared to older individuals or those with health conditions. Guaranteed acceptance. While not always guaranteed, younger applicants are more likely to qualify for coverage without exclusions due to pre-existing conditions. Wider plan options. A broader range of plans and benefit options might be available to younger individuals, allowing them to choose a plan that best fits their needs and budget. Reference: National Association of Insurance Commissioners, Long-Term Care Insurance. Question 35. A life insurance agent is contacted by a potential client who wants to purchase a whole life insurance policy. The client is interested in building cash value alongside the death benefit. What are some key points the agent should explain to the client about whole life insurance cash value? A. The cash value in a whole life insurance policy grows at a guaranteed interest rate. B. The policyholder can access the cash value through withdrawals or loans, but this may reduce the death benefit. C. There may be surrender charges for withdrawing cash value in the early years of the policy. D. All of the above points are important to explain about whole life insurance cash value. The correct answer is D. All of the above points are important to explain about whole life insurance cash value. Whole life insurance offers a guaranteed death benefit and a cash value component that accumulates over time. Here are some key points to explain to the client. Guaranteed interest rate. Whole life cash value grows at a fixed interest rate, although it may be lower than what some other investment options might offer. Cash value access. The policyholder can access the cash value through withdrawals or loans. However, withdrawals will reduce the death benefit payout, and loans accrue interest that needs to be repaid. Surrender charges. Canceling a whole life policy before it accumulates significant cash value may result in surrender charges. These charges can be a significant portion of the premiums paid, especially for newer policies. Reference: National Association of Insurance Commissioners, Whole Life Insurance. Question 36. A client is interested in purchasing a disability income insurance policy. They inquire about the difference between an own occupation definition of disability and an any occupation definition of disability. How should the agent explain these terms? A. An own occupation definition only provides benefits if the disability prevents the client from working in their specific occupation. B. An any occupation definition provides benefits if the client can no longer work in any occupation for which they are qualified. C. Own occupation is more common and typically offers higher benefits compared to any occupation disability insurance. D. There is no significant difference. Both terms refer to the same type of disability coverage. The correct answer is A. An own occupation definition only provides benefits if the disability prevents the client from working in their specific occupation. Disability income insurance policies define disability based on your ability to work in your current occupation or any occupation. Here's a breakdown of the key differences. Own occupation definition. This definition pays benefits if you become disabled and cannot perform the substantial duties of your specific occupation, even if you can perform another occupation. Any occupation definition. This definition has a stricter requirement. Benefits are only paid if you become disabled and cannot perform any occupation for which you are reasonably qualified, based on your education, training, and experience. Reference: National Association of Insurance Commissioners. Disability Income Insurance. Question 37. An agent is reviewing a health insurance application with a client. The client hesitates to disclose a pre-existing medical condition because they are worried it will affect their coverage. What is the best course of action for the agent to advise the client? A. The agent can downplay the importance of disclosing the condition, as some insurers may not discover it during underwriting. B. Advise the client to be honest and disclose all pre-existing conditions on the application. C. The agent can recommend the client wait until their health improves before applying for health insurance. D. Advise the client to seek legal advice regarding the disclosure of pre-existing medical conditions. The correct answer is B. Advise the client to be honest and disclose all pre-existing conditions on the application. It is essential for clients to disclose all pre-existing medical conditions on their health insurance application truthfully and completely. Here's why. Insurance fraud. Failing to disclose pre-existing conditions can be considered insurance fraud and could result in claim denials or policy cancellation. Accurate underwriting. Honest disclosure allows the insurance company to accurately assess the risk and determine appropriate coverage and premiums. Reference: National Association of Health Underwriters, Health Insurance Applications and Underwriting. Question 38. A health insurance company in Nebraska is developing a new vision insurance plan. What are some typical benefits that might be included in a vision insurance plan? A. Routine eye exams and preventive care. B. Coverage for eyeglasses or contact lenses. C. Discounts on LASIK surgery or other vision correction procedures. D. All of the above benefits may be included in a vision insurance plan. The correct answer is D. All of the above benefits may be included in a vision insurance plan. Vision insurance plans typically offer a combination of benefits to help policyholders manage eye care costs. Here are some common inclusions. Routine eye exams and preventive care. This covers the cost of regular eye exams, which can help detect vision problems early on. Coverage for eyeglasses or contact lenses. The plan may provide a benefit towards the purchase of eyeglasses or contact lenses, with coverage limits or copayments. Discounts on LASIK surgery or other vision correction procedures. Some plans offer discounts on elective procedures like LASIK surgery or other vision correction methods. Reference: America's Health Insurance Plans. Understanding Vision Insurance. Question 39. A client is nearing retirement and is concerned about potential long-term care needs. They inquire about the possibility of converting their existing life insurance policy into a long-term care insurance plan. Can life insurance policies be converted to long-term care insurance? A. No. Life insurance policies cannot be converted to long-term care insurance plans. B. Conversion is possible with any life insurance policy, regardless of type or value. C. Some life insurance policies, particularly universal life policies with sufficient cash value, may offer conversion options to long-term care coverage. D. The client should simply cancel their life insurance policy and use the money to pay for long-term care when needed. The correct answer is C. Some life insurance policies, particularly universal life policies with sufficient cash value, may offer conversion options to long-term care coverage. Not all life insurance policies can be converted to long-term care insurance. However, some policies, particularly universal life insurance plans with a significant accumulated cash value, may offer riders or provisions allowing conversion to long-term care coverage. Reference: National Association of Insurance Commissioners, Long-Term Care Insurance. Question 40. An agent is explaining critical illness insurance to a client. What is a typical claim scenario for critical illness insurance? A. The policyholder is diagnosed with a covered critical illness, such as cancer or heart attack, and receives a lump sum benefit. B. The insurance company covers the cost of all medical treatments for the critical illness. C. Critical illness insurance pays benefits if the client is hospitalized for an extended period due to a serious illness. D. Benefits are only paid upon the death of the policyholder from a covered critical illness. The correct answer is A. The policyholder is diagnosed with a covered critical illness, such as cancer or heart attack, and receives a lump sum benefit. Critical illness insurance provides a financial safety net if the policyholder is diagnosed with a covered critical illness. Here's how a typical claim scenario unfolds. The policyholder is diagnosed with a critical illness listed in the policy definition, e.g., cancer, heart attack, stroke. The policyholder submits a claim with the required medical documentation. If the claim is approved, the insurance company pays a lump sum benefit directly to the policyholder. Reference: National Association of Insurance Commissioners, Critical Illness Insurance. Question 41. A health insurance company in Nebraska receives a complaint from a policyholder who has been denied coverage for a specific medical procedure. What are the next steps the insurance company should take when handling this type of complaint? A. Deny the appeal without further review unless the policyholder submits new medical evidence. B. Investigate the complaint by reviewing the policy terms, medical records, and applicable guidelines used for coverage decisions. C. Advise the policyholder to contact their doctor to discuss alternative treatment options. D. Offer the policyholder a discount on their premiums to compensate for the denied coverage. The correct answer is B. Investigate the complaint by reviewing the policy terms, medical records, and applicable guidelines used for coverage decisions. When a policyholder appeals a coverage denial, the insurance company has a responsibility to investigate the complaint thoroughly. Here's what typically happens. Review the complaint. The company should review the details of the complaint, including the denied procedure and the reason for denial. Policy review. The policy language related to the denied service is examined to determine if the procedure falls under covered benefits. Medical records review. The insurance company may request additional medical records to assess the medical necessity of the procedure. Guidelines review. The company should ensure the coverage decision followed established guidelines and procedures for claims adjudication. Reference: National Association of Health Underwriters, Health Insurance Appeals Process. Question 42. A young adult is considering purchasing their first health insurance policy. They are relatively healthy and don't visit the doctor frequently. What factors should the agent consider when recommending a health insurance plan to this client? A. The client's current health status and anticipated medical needs. B. Budget and affordability of different plan options. C. Preferred healthcare providers and hospitals within the plan network. D. All of the above factors are important to consider when recommending a health insurance plan. The correct answer is D. All of the above factors are important to consider when recommending a health insurance plan. Recommending a suitable health insurance plan for a young adult client requires considering several factors. Health status and needs. While the client may be healthy now, understanding their anticipated medical needs, e.g., family planning, potential chronic conditions, can help determine coverage needs. Budget. Affordability is crucial. Consider premiums, deductibles, copays, and out-of-pocket maximums to fit the client's budget. Network providers. Does the plan offer access to preferred doctors, specialists, and hospitals within a convenient location? Preventative care coverage. The plan should ideally cover preventive care services like checkups and vaccinations to help maintain good health. Reference: Centers for Medicare and Medicaid Services. Choosing a health plan. Question 43. An agent is meeting with a client interested in disability income insurance. The client inquires about the difference between a short-term disability benefit period and a long-term disability benefit period. A. Short-term disability benefits are paid for a longer duration than long-term disability benefits. B. Short-term disability benefits typically cover a period of 2 to 6 months, while long-term benefits can last for years. C. Short-term disability benefits pay a higher percentage of the client's income compared to long-term benefits. D. There is no significant difference. Both terms refer to the same type of disability benefit. The correct answer is B. Short-term disability benefits typically cover a period of 2 to 6 months, while long-term benefits can last for years. Disability income insurance policies define the duration for which benefits are paid in case of disability. Here's a breakdown of the key terms. Short-term disability. This benefit typically covers a shorter duration, often lasting 2 to 6 months, to help replace income while the policyholder recovers from a temporary illness or injury. Long-term disability. This benefit provides income replacement for a more extended period, potentially years, if the disability prevents the client from working for an extended period. Reference: National Association of Insurance Commissioners. Disability income insurance. Question 44. A client is interested in purchasing a Medicare supplement, Medigap, plan to supplement their Medicare coverage. What is an important benefit to consider when choosing a Medigap plan? A. Medigap plans offer various standardized options with different levels of coverage, so clients can choose a plan that best fits their needs and budget. B. All Medigap plans cover the cost of prescriptions drugs. C. Medigap plans typically have lower premiums compared to Medicare Advantage plans, Part C. D. Medigap plans are mandatory for all Medicare beneficiaries. The correct answer is A. Medigap plans offer various standardized options with different levels of coverage, so clients can choose a plan that best fits their needs and budget. Medicare Supplement, Medigap, plans offer standardized benefits with different plan options, e.g., Plan A, Plan F, etc. Here's why choosing the right plan is important. Standardized benefits. Each Medigap plan type has a defined set of benefits, ensuring clear coverage details across different insurance companies offering that specific plan. Needs-based selection. Clients can compare plan options, benefits, premiums, to choose the one that best addresses their out-of-pocket cost concerns under Medicare and fits their budget. Reference: Medicare.gov. Medicare Supplement Insurance, Medigap. Question 45. A client inquires about accident insurance while renewing their homeowner's insurance policy. How does accidental death benefit coverage within homeowner's insurance differ from a standalone accident insurance policy? A. Accidental death benefit in homeowner's insurance only covers accidents within the home, while standalone accident insurance offers broader coverage. B. Standalone accident insurance provides a much higher death benefit payout compared to accidental death benefit riders on homeowners' policies. C. Homeowners insurance with accidental death benefit covers all accidental deaths, while standalone policies only cover specific accidents. D. There is no significant difference. Both offer similar coverage for accidental death. The correct answer is A. Accidental death benefit in homeowners insurance only covers accidents within the home, while standalone accident insurance offers broader coverage. Here's a breakdown of the key differences between accidental death benefit riders on homeowners insurance and standalone accident insurance policies. Coverage scope. Accidental death benefit in homeowners insurance typically covers accidental deaths that occur within the insured property. Standalone accident insurance offers broader coverage, potentially extending to accidental deaths anywhere. Benefit amount. The accidental death benefit in homeowners insurance is usually a smaller, fixed amount. Standalone accident insurance policies can offer a higher death benefit payout, depending on the chosen coverage amount. Reference: National Association of Insurance Commissioners, Homeowners Insurance. National Association of Insurance Commissioners, Accident Insurance. Question 46. A life insurance agent is contacted by a potential client who wants to purchase a cancer insurance policy. How does cancer insurance differ from critical illness insurance? A. Cancer insurance only covers the costs associated with cancer treatment, while critical illness insurance covers a wider range of critical illnesses. B. Cancer insurance policies typically offer a lump sum benefit upon diagnosis, whereas critical illness insurance may pay benefits in stages throughout treatment. C. There is no significant difference. Both cancer insurance and critical illness insurance cover the same conditions. D. Cancer insurance is a rider that can be added to a life insurance policy, while critical illness insurance is a standalone policy. The correct answer is A. Cancer insurance only covers the costs associated with cancer treatment, while critical illness insurance covers a wider range of critical illnesses. While both cancer insurance and critical illness insurance offer financial protection for severe medical conditions, there are key differences. Covered conditions. Cancer insurance focuses specifically on cancer diagnosis and treatment. Critical illness insurance covers a broader range of critical illnesses, including cancer, heart attack, stroke, and others listed in the policy definition. Benefit structure. Cancer insurance policies may provide a lump sum benefit upon diagnosis or throughout treatment, depending on the specific plan. Critical illness insurance benefits can be structured in various ways, including a lump sum payout upon diagnosis, staged payments during treatment, or a combination of both. Reference: National Association of Insurance Commissioners, Cancer Insurance. National Association of Insurance Commissioners, Critical Illness Insurance. Question 47. An agent is explaining the concept of health insurance deductibles to a client. What does a deductible represent in a health insurance plan? A. The monthly premium paid by the policyholder to maintain coverage. B. The out-of-pocket amount the policyholder pays for covered medical services before the insurance company starts sharing the costs. C. The maximum amount the policyholder will be responsible for in a calendar year, regardless of covered medical expenses. D. A fixed percentage of the total medical bill that the policyholder needs to pay before the insurance company kicks in. The correct answer is B. The out-of-pocket amount the policyholder pays for covered medical services before the insurance company starts sharing the costs. A deductible is an essential concept in health insurance plans. Here's how it works. The deductible is the out-of-pocket amount the policyholder pays for covered medical services before the insurance company starts sharing the costs. Once the deductible is met, the insurance company typically pays a certain percentage, coinsurance, of covered expenses, and the policyholder may also have a copayment for specific services. Reference: Centers for Medicare and Medicaid Services, Understanding Health Insurance. Question 48. A client is interested in purchasing a long-term care insurance policy. They express concern about the possibility of premiums increasing in the future. How can you address the client's concern? A. Guaranteed renewable long-term care insurance policies lock in the premium amount for the entire policy term. B. While premiums can't be guaranteed, some long-term care policies offer features that limit premium increases. C. Clients should expect significant premium increases for long-term care insurance as they age. D. Advise the client to wait until they need long-term care before purchasing insurance, as premiums will be lower. The correct answer is B. While premiums can't be guaranteed, some long-term care policies offer features that limit premium increases. While long-term care insurance premiums can't be guaranteed to stay the same forever, some policies offer features that help manage future cost increases. Guaranteed renewable provisions. These ensure the policy cannot be canceled by the insurance company, and premiums can only increase under certain conditions outlined in the policy. Level premium options. Some plans offer level premiums throughout the policy term, providing predictability in costs. Graded benefit options. These plans may allow for initial lower premiums with benefits that increase over time, potentially helping manage future cost increases. Reference: National Association of Insurance Commissioners, Long-Term Care Insurance. Question 49. An agent is reviewing a health insurance application with a client. The client asks if they should list a pre-existing condition that is currently well controlled with medication. How should the agent respond? A. The agent can advise the client to omit the pre-existing condition to avoid higher premiums. B. Advise the client to disclose all pre-existing conditions truthfully, regardless of current management. C. The agent can recommend the client wait until their condition worsens before applying for health insurance. D. Advise the client to seek medical advice regarding the disclosure of pre-existing medical conditions. The correct answer is B. Advise the client to disclose all pre-existing conditions truthfully, regardless of current management. It is essential for clients to disclose all pre-existing medical conditions on their health insurance application truthfully and completely, regardless of current management. Here's why. Accurate underwriting. Honest disclosure allows the insurance company to assess the risk accurately and determine appropriate coverage and premiums. Policy cancellation. Failing to disclose pre-existing conditions can be considered insurance fraud and could result in claim denials or policy cancellation. Reference: National Association of Health Underwriters, Health Insurance Applications and Underwriting. Question 50. A health insurance company in Nebraska is developing a new dental insurance plan for children. What are some typical benefits that might be included in a children's dental insurance plan? A. Coverage for routine cleanings, fillings, and fluoride treatments. B. Orthodontic treatment, braces or retainers, to correct misaligned teeth. C. Oral surgery procedures like wisdom teeth removal. D. All of the above benefits may be included in a children's dental insurance plan. The correct answer is D. All of the above benefits may be included in a children's dental insurance plan. Children's dental insurance plans typically focus on preventive care and basic restorative procedures to promote good oral health habits. Here are some common inclusions. Routine care. This covers cleanings, exams, x-rays, and fluoride treatments to help prevent cavities and gum disease. Restorative procedures. These may include fillings, crowns, or root canals to repair damaged teeth. Orthodontics. Some plans may offer coverage for orthodontic treatment, braces or retainers, to correct misaligned teeth, with annual or lifetime maximums. Oral surgery. Certain plans may cover oral surgery procedures like wisdom teeth removal, subject to policy limits. Reference: National Association of Dental Plans, Dental Insurance for Kids. Question 51. A client inquires about riders that can be added to their existing whole life insurance policy. What are some common rider options offered with whole life insurance? A. Accidental death benefit rider. Provides an additional death benefit payout if the death is accidental. B. Waiver of premium rider. Pays the premiums for the policy if the policyholder becomes disabled and meets the rider's definition of disability. C. Guaranteed insurability rider. Allows the policyholder to purchase additional coverage amounts at guaranteed rates in the future without medical underwriting. D. All of the above riders are common options available with whole life insurance policies. The correct answer is D. All of the above riders are common options available with whole life insurance policies. Whole life insurance policies often allow adding riders to customize the coverage and enhance benefits. Here are some common rider options. Accidental death benefit rider. This rider provides an additional death benefit payout if the insured dies due to an accident. Waiver of premium rider. This rider waives the future premiums if the policyholder becomes disabled and meets the rider's definition of disability, ensuring the policy remains active. Guaranteed Insurability Rider. This rider allows the policyholder to purchase additional coverage amounts at guaranteed rates in the future, without undergoing medical underwriting again, which can be beneficial if their health condition changes. Reference: National Association of Insurance Commissioners, Whole Life Insurance. Question 52. An agent is explaining Medicare Part D, prescription drug coverage, to a client. What is an important factor for clients to consider when choosing a Medicare Part D plan? A. The formulary, which is a list of drugs covered by the plan and the associated tiers with different copay amounts. B. The plan's network of pharmacies to ensure the client has convenient access to pick up their medications. C. Whether the plan covers specific brand name drugs the client currently uses. D. All of the above factors are important to consider when choosing a Medicare Part D plan. The correct answer is D. All of the above factors are important to consider when choosing a Medicare Part D plan. Choosing a suitable Medicare Part D plan requires considering several factors to ensure it meets the client's specific needs. Formulary. This list details the covered medications and their associated tiers. Each tier has a different copay amount, so understanding the formulary is crucial. Pharmacy network. The plan's network of pharmacies determines where the client can conveniently pick up their medications. Specific drug coverage. Checking if the plan covers the specific brand name drugs the client currently uses is essential to avoid unexpected costs. Cost factors. Consider premiums, deductibles, and copay amounts to find a plan that fits the client's budget. Reference: Medicare.gov, Medicare Part D, prescription drug coverage. Question 53. A life insurance agent is contacted by a potential client interested in purchasing a variable universal life insurance policy. What is a key characteristic of variable universal life insurance? A. Variable universal life insurance offers a guaranteed minimum death benefit, along with the potential for cash value growth based on investment performance. B. The premiums and death benefit are fixed throughout the policy term in variable universal life insurance. C. Variable universal life insurance is a type of term life insurance with a flexible premium payment schedule. D. Variable universal life insurance is similar to whole life insurance, but with no cash value accumulation component. The correct answer is A. Variable universal life insurance offers a guaranteed minimum death benefit, along with the potential for cash value growth based on investment performance. Variable universal life insurance combines features of universal life insurance with a variable investment component. Here's a key characteristic: guaranteed death benefit and variable cash value. The policy offers a guaranteed minimum death benefit, but the cash value has the potential to grow based on the performance of the underlying investments chosen by the policyholder. This means the cash value can fluctuate depending on market conditions. Reference: National Association of Insurance Commissioners, Variable Universal Life Insurance. Question 54. A young adult is moving out of their parents' house and wants to purchase their own health insurance plan. What are some factors this client should consider when choosing a health insurance plan? A. The client's current health status and anticipated medical needs, e.g., ongoing medications, potential for future conditions. B. Budget and affordability of different plan options, considering factors like premiums, deductibles, and copays. C. Preferred healthcare providers and hospitals within the plan network to ensure convenient access to care. D. All of the above factors are important to consider when choosing a health insurance plan for a young adult. The correct answer is D. All of the above factors are important to consider when choosing a health insurance plan for a young adult. Choosing a suitable health insurance plan for a young adult requires a comprehensive approach, considering several factors. Health status and needs. While they might be healthy now, considering potential future needs, e.g., medications, family planning, helps determine coverage requirements. Budget. Affordability is crucial. Analyze premiums, deductibles, and copays to find a plan that fits the client's financial situation. Network providers. Does the plan offer access to preferred doctors, specialists, and hospitals within a convenient location? Preventative care coverage. The plan should ideally cover preventive care services like checkups and vaccinations to help maintain good health. Reference. Centers for Medicare and Medicaid Services. Choosing a health plan. Question 55. An agent is meeting with a client who wants to cancel their current health insurance plan and enroll in a new plan during the open enrollment period. What is an important thing for the agent to remind the client about before canceling their existing plan? A. New plans may require medical underwriting, and the client might not be guaranteed coverage due to pre-existing conditions. B. There could be a waiting period before coverage begins under the new plan, leaving the client with a gap in coverage. C. The client will likely lose any unused benefits or accumulated value under their current plan. D. All of the above points are important to remind the client about before canceling their existing health insurance plan. The correct answer is D. All of the above points are important to remind the client about before canceling their existing health insurance plan. Before canceling their existing health insurance plan, it's crucial to remind the client about potential consequences. Medical underwriting. New plans might require medical underwriting, where pre-existing conditions could affect eligibility or premiums. Waiting period. New plans often have a waiting period before coverage starts, leaving a gap without health insurance coverage. Loss of benefits. Canceling the current plan means losing any unused benefits or accumulated value, like unused funds in a health savings account, HSA. Reference. Centers for Medicare and Medicaid Services. Marketplace Open Enrollment. Question 56. A client is interested in purchasing disability income insurance. What factors should the agent consider when helping the client choose a suitable disability income insurance plan? A. The client's occupation, income level, and desired benefit amount to ensure the coverage adequately replaces lost income in case of disability. B. The definition of disability within the policy, own occupation versus any occupation, to determine eligibility for benefits based on the client's ability to work in their specific job or any occupation. C. The benefit elimination period, waiting period, before payments begin, and the benefit period, duration for which the policy pays benefits, to address potential financial gaps during disability. D. All of the above factors are important to consider when recommending a disability income insurance plan. The correct answer is D. All of the above factors are important to consider when recommending a disability income insurance plan. Recommending a suitable disability income insurance plan requires considering several factors to ensure it meets the client's needs. Income replacement. Consider the client's occupation, income level, and desired benefit amount. The plan should provide sufficient income replacement to cover expenses if they become disabled. Definition of disability. Own occupation provides benefits if the client cannot perform their specific job, while any occupation offers benefits if they cannot work in any occupation for which they are qualified. Benefit period and elimination period. The benefit elimination period is the waiting time before benefits start. The benefit period determines how long the policy pays benefits, e.g., 2 years, to age 65. Reference. National Association of Insurance Commissioners. Disability Income Insurance. Question 57. A client inquires about critical illness insurance riders that can be added to their existing term life insurance policy. What is an advantage of adding a critical illness rider to a term life insurance policy? A. Critical illness riders extend the term life insurance coverage beyond the initial policy term if the client is diagnosed with a critical illness. B. Adding a critical illness rider provides a guaranteed death benefit payout in case of death from any cause, in addition to the potential benefit for a covered critical illness. C. The death benefit under the term life insurance policy is increased automatically if a critical illness rider is added. D. Critical illness riders typically come with lower premiums compared to standalone critical illness insurance policies. The correct answer is B. Adding a critical illness rider provides a guaranteed death benefit payout in case of death from any cause, in addition to the potential benefit for a covered critical illness. Adding a critical illness rider to a term life insurance policy offers several advantages. Financial protection for critical illness. The rider provides a lump sum benefit payout upon diagnosis of a covered critical illness, helping manage the financial burden of treatment and recovery. Maintains death benefit. The guaranteed death benefit from the term life insurance policy remains in effect, providing financial security for beneficiaries in case of death from any cause, even after a critical illness claim. Important note: critical illness riders typically do not extend the term life insurance coverage. Reference: National Association of Insurance Commissioners, Critical Illness Insurance. Question 58. A health insurance company is developing a new health insurance plan specifically for Medicare beneficiaries. What are some important considerations for designing a plan that meets the needs of this population? A. The plan should offer comprehensive coverage for chronic conditions that are common among seniors, such as diabetes and heart disease. B. Consider incorporating benefits for preventive care services like mammograms and colonoscopies to promote early detection of health issues. C. The plan should be designed to work seamlessly with Medicare Parts A and B, hospital insurance and medical insurance, to minimize gaps in coverage. D. All of the above considerations are important for designing a Medicare supplement plan. The correct answer is D. All of the above considerations are important for designing a Medicare supplement plan. Designing a health insurance plan for Medicare beneficiaries requires addressing their specific needs. Chronic condition coverage. The plan should cover treatment for chronic conditions prevalent among seniors, such as diabetes, heart disease, and arthritis. Preventive care. Include benefits for preventive screenings and wellness services like mammograms, colonoscopies, and immunizations. Coordination with Medicare. The plan should integrate seamlessly with Medicare Parts A and B to minimize out-of-pocket costs and avoid coverage gaps. Reference: Centers for Medicare and Medicaid Services, Medicare Supplement Insurance, Medigap. Question 59. An agent is explaining long-term care insurance options to a client. The client expresses concern about the cost of long-term care and wonders if there are alternatives to purchasing long-term care insurance. A. There are no alternatives. Long-term care insurance is the only way to pay for long-term care services. B. While long-term care insurance is a good option, clients can explore alternatives like self-funding, relying on family support, or utilizing government assistance programs. C. Clients can modify their existing homeowner's insurance policy to cover long-term care expenses. D. Purchasing additional disability income insurance can cover the cost of long-term care services. The correct answer is B. While long-term care insurance is a good option, clients can explore alternatives like self-funding, relying on family support, or utilizing government assistance programs. While long-term care insurance is a valuable tool for managing long-term care costs, there are alternative options. Self-funding. Clients can save money over time to pay for long-term care expenses out of pocket. Family support. Some families can rely on informal care provided by loved ones to help manage long-term care needs. Government assistance programs. Programs like Medicaid may offer limited long-term care benefits under specific eligibility criteria. Important note: homeowners insurance and disability income insurance typically do not cover long-term care expenses. Reference: National Association of Insurance Commissioners, Long-Term Care Insurance. Question 60. A client is interested in purchasing a disability income insurance policy. They inquire about the difference between an own occupation disability benefit and an any occupation disability benefit. A. An own occupation benefit provides a higher payout compared to an any occupation benefit. B. And any occupation benefit pays benefits if the client can still work in any occupation for which they are qualified, even if they cannot perform their specific job duties. C. An own occupation benefit pays benefits only if the disability prevents the client from working in their specific occupation, even if they could perform other types of work. D. There is no significant difference. Both terms refer to the same type of disability benefit. The correct answer is C. An own occupation benefit pays benefits only if the disability prevents the client from working in their specific occupation, even if they could perform other types of work. Disability income insurance policies define the conditions under which benefits are paid based on the ability to work. Here's the key difference between own occupation and any occupation benefits. Own occupation benefit. This benefit offers the most stringent definition of disability. Benefits are paid only if the disability prevents the client from performing the substantial duties of their specific occupation, even if they could perform other types of work. Any occupation benefit. This broader definition provides benefits if the disability prevents the client from working in any occupation for which they are reasonably qualified, based on their education, training, and experience. Reference: National Association of Insurance Commissioners. Disability Income Insurance. Question 61. An agent is meeting with a client who wants to increase their life insurance coverage. The client is concerned about the impact on their current budget. What are some strategies the agent can suggest to make the increased coverage more affordable? A. The agent can recommend reducing the coverage amount on the existing policy to offset the premium cost of the new policy. B. Consider term life insurance with a longer term length, which typically offers lower premiums compared to shorter term policies. C. Depending on the type of existing policy, increasing the deductible on a whole life insurance policy can lower the premium. D. All of the above strategies can be considered to make increased life insurance coverage more affordable. The correct answer is D. All of the above strategies can be considered to make increased life insurance coverage more affordable. Here are some strategies to help a client increase their life insurance coverage while managing affordability. Term life options. Consider term life insurance with a longer term length, e.g., 20 or 30 years, as premiums are typically lower compared to shorter term policies. Review existing coverage. Analyze the existing policy. If it's whole life insurance, increasing the deductible can potentially lower the premium. However, this reduces the cash value accumulation. Reduce existing coverage, if applicable. In some cases, reducing the death benefit on an existing policy might be an option to free up budget for the new policy, but this should be carefully considered to ensure sufficient total coverage. Important note: reducing existing coverage or increasing deductibles might have implications on the overall financial strategy. It's crucial to discuss all options with the client to find the most suitable approach. Reference: National Association of Insurance Commissioners, Life Insurance. Question 62. Mr. Hernandez is a resident of Omaha, Nebraska, and wants to purchase a long-term care insurance policy. He is concerned about the potential for premium increases in the future. Which of the following statements is most accurate regarding premium increases for long-term care insurance policies in Nebraska? A. In Nebraska, long-term care insurance premiums cannot increase after the policy is issued. B. Guaranteed renewable long-term care insurance policies in Nebraska cannot have premium increases unless approved by the Nebraska Department of Insurance. C. Non-cancelable long-term care insurance policies in Nebraska are guaranteed to have level premiums throughout the life of the policy. D. All long-term care insurance policies in Nebraska are subject to premium increases at any time by the insurer. The correct answer is B. Guaranteed renewable long-term care insurance policies in Nebraska cannot have premium increases unless approved by the Nebraska Department of Insurance. Nebraska law requires long-term care insurance policies to be guaranteed renewable, meaning the insurer cannot cancel the policy as long as premiums are paid. However, premiums for guaranteed renewable policies can be increased, but only with prior approval from the Nebraska Department of Insurance. This approval process helps ensure that any premium increases are justified and reasonable. Question 63. Ms. Davis is a life insurance agent licensed in Nebraska. She is explaining Medicare supplement insurance to a client. Which of the following statements is most accurate regarding Medicare supplement insurance policies in Nebraska? A. Medicare supplement insurance policies in Nebraska are standardized and offered by all insurers. B. Medicare supplement insurance policies in Nebraska can have different benefits and premiums depending on the insurer. C. Medicare supplement insurance policies in Nebraska cannot be guaranteed renewable. D. Medicare supplement insurance policies in Nebraska cover all the costs associated with Medicare Part A and Part B. The correct answer is B. Medicare supplement insurance policies in Nebraska can have different benefits and premiums depending on the insurer. Medicare supplement insurance policies in Nebraska are not standardized. This means different insurers can offer plans with varying benefits and premiums. It's crucial for Ms. Davis to explain these differences to her client so they can choose the plan that best fits their needs and budget. Medicare supplement insurance primarily helps pay for out-of-pocket costs associated with Medicare Part A and Part B, but it may not cover everything. Question 64. A Nebraska resident is considering purchasing a health insurance policy with a high deductible. They are also interested in a health savings account, HSA, to help save money for qualified medical expenses. According to Nebraska regulations, which of the following statements is true regarding eligibility for HSAs? A. Only individuals enrolled in a health insurance plan with a deductible of over $5,000 are eligible for HSAs in Nebraska. B. There are no minimum deductible requirements for HSA eligibility in Nebraska, but the health plan must be a high deductible health plan, HDHP, as defined by the IRS. C. HSAs are not available to Nebraska residents enrolled in employer-sponsored health insurance plans. D. Contributions to HSAs are not tax-deductible in Nebraska. The correct answer is B. There are no minimum deductible requirements for HSA eligibility in Nebraska, but the health plan must be a high deductible health plan, HDHP, as defined by the IRS. Eligibility for HSAs is governed by federal regulations set by the IRS, not by individual states. To qualify for an HSA in Nebraska, an individual must be enrolled in a health insurance plan that meets the IRS definition of a high deductible health plan, HDHP. This means the plan must have a minimum annual deductible amount. The specific minimum deductible amount can change year to year, so it's important to check with the IRS for the latest guidelines. HSAs can be used in conjunction with employer-sponsored health plans as long as the plan qualifies as an HDHP. Contributions made to HSAs with pre-tax dollars are generally tax-deductible under federal law. Question 65. Ms. Lee is a life insurance agent in Nebraska and is explaining replacement of life insurance policies to a client. According to Nebraska replacement life insurance laws, which of the following statements is most accurate? A. There is no requirement for Ms. Lee to provide a written notice to the existing insurer before replacing a life insurance policy in Nebraska. B. A written notice to the existing insurer is required in Nebraska, but only if the new policy is with a different insurer. C. A replacement notice must be delivered to the policyholder in Nebraska at least 10 days before submitting an application for a new policy. D. Both a written notice to the existing insurer and a replacement notice to the policyholder are required in Nebraska before replacing a life insurance policy. The correct answer is D. Both a written notice to the existing insurer and a replacement notice to the policyholder are required in Nebraska before replacing a life insurance policy. Nebraska replacement life insurance laws require a two-pronged approach. Ms. Lee must deliver a written notice to the existing insurer disclosing her intent to replace the policy. Additionally, she must provide a replacement notice directly to the policyholder. This notice, typically delivered at least 10 days before submitting the new application, informs the policyholder of their right to decline the replacement and keep their existing policy. Question 66. A consumer in Nebraska is shopping for critical illness insurance. They are concerned about the financial burden of a critical illness and want a policy that will provide a lump sum cash benefit upon diagnosis. Which of the following statements is most accurate regarding critical illness insurance benefits in Nebraska? A. Critical illness insurance policies in Nebraska are mandated to cover a specific list of critical illnesses. B. Critical illness insurance policies in Nebraska can define covered critical illnesses at the discretion of the insurer. C. Benefits from critical illness insurance policies in Nebraska are subject to income tax. D. Critical illness insurance policies in Nebraska cannot be guaranteed renewable. The correct answer is B. Critical illness insurance policies in Nebraska can define covered critical illnesses at the discretion of the insurer. Critical illness insurance policies in Nebraska are not standardized. Insurers have the flexibility to define which critical illnesses are covered under their policies. It's crucial for consumers to carefully review the policy details to understand exactly what illnesses are covered and the benefit payout amounts. Benefits received from critical illness insurance policies are generally not considered taxable income in Nebraska unless the premiums were paid with after-tax dollars. Question 67. Mr. Garcia is a resident of Lincoln, Nebraska, and is considering purchasing an accident insurance policy. He is concerned about the potential for claim denials based on exclusions in the policy. According to Nebraska insurance regulations, which of the following statements is most accurate regarding accident insurance exclusions? A. Accident insurance policies in Nebraska cannot have any exclusions. B. Accident insurance policies in Nebraska must have all exclusions clearly outlined in the policy wording. C. Certain exclusions, such as self-inflicted injuries, are prohibited in accident insurance policies sold in Nebraska. D. The specific exclusions allowed in accident insurance policies in Nebraska are determined by the agent selling the policy. The correct answer is B. Accident insurance policies in Nebraska must have all exclusions clearly outlined in the policy wording. Nebraska insurance regulations require accident insurance policies to clearly outline all exclusions within the policy wording. This allows consumers like Mr. Garcia to understand what situations might not be covered by the policy. While some common exclusions, like self-inflicted injuries or participation in hazardous activities, may be included, there are no specific exclusions mandated or prohibited by Nebraska law. Question 68. Ms. Johnson is a resident of Grand Island, Nebraska, and is considering applying for long-term care insurance. She is concerned about the possibility of pre-existing conditions affecting her eligibility. According to Nebraska insurance regulations, how can pre-existing conditions impact long-term care insurance applications? A. Insurers in Nebraska cannot deny coverage based solely on pre-existing conditions. B. Pre-existing conditions can lead to denial of coverage, but guaranteed renewable policies cannot be canceled after issuance. C. Insurers can deny or limit coverage for pre-existing conditions, but they must disclose their underwriting guidelines. D. Pre-existing conditions automatically disqualify an applicant from obtaining long-term care insurance in Nebraska. The correct answer is C. Insurers can deny or limit coverage for pre-existing conditions, but they must disclose their underwriting guidelines. Nebraska allows insurers to consider pre-existing conditions when evaluating long-term care insurance applications. This means they can deny coverage, limit benefits, or charge higher premiums based on pre-existing health conditions. However, insurers are required to disclose their underwriting guidelines, which outline how they evaluate health information and make coverage decisions. This transparency allows Ms. Johnson to understand how her health history might impact her application. Question 69. Mr. Anderson is a life insurance agent working in Nebraska. He is explaining grace periods to a client who is considering a new life insurance policy. Which of the following statements is most accurate regarding grace periods for life insurance policies in Nebraska? A. Life insurance policies in Nebraska are not required to offer a grace period for premium payments. B. The minimum grace period for life insurance policies in Nebraska is 10 days. C. All life insurance policies in Nebraska must offer a grace period of at least 30 days for premium payments. D. The grace period for life insurance policies in Nebraska is determined by the policyholder and can be negotiated with the agent. The correct answer is C. All life insurance policies in Nebraska must offer a grace period of at least 30 days for premium payments. Nebraska law mandates that all life insurance policies offer a minimum grace period of 30 days for premium payments. This grace period allows policyholders additional time to make their premium payment before the policy lapses. Mr. Anderson should explain the grace period details to his client and ensure they understand the importance of timely premium payments. Question 70. A consumer in Nebraska is interested in purchasing a disability income insurance policy. They are concerned about the financial impact of a disability and want a policy that will provide them with monthly income if they become disabled. According to Nebraska insurance regulations, which of the following statements is most accurate regarding disability income insurance benefits? A. Disability income insurance benefits in Nebraska are not subject to income tax. B. Disability income insurance benefits in Nebraska are taxable if the premiums were paid with pre-tax dollars. C. There is a minimum benefit amount required for all disability income insurance policies sold in Nebraska. D. Disability income insurance benefits in Nebraska automatically continue until the policyholder reaches retirement age. The correct answer is B. Disability income insurance benefits in Nebraska are taxable if the premiums were paid with pre-tax dollars. The tax treatment of disability income insurance benefits in Nebraska depends on how the premiums were paid. If the premiums were paid with pre-tax dollars through employer-sponsored plans, for example, then the benefits received are generally considered taxable income. However, if the premiums were paid with after-tax dollars, the benefits may be tax-free. It's important for consumers to understand the tax implications of their disability income insurance policy. There is no mandated minimum benefit amount for disability income insurance in Nebraska. The benefit amount typically depends on the specific policy and the insured's income. Disability income benefits typically continue until a defined period, often 2 years, or until the policyholder reaches a certain age, such as 65. Question 71. Ms. Brown is a resident of Norfolk, Nebraska, and is considering purchasing a Medicare supplement insurance policy, Medigap. She is aware that Medigap plans are standardized by the federal government. However, she is also concerned about the cost of different Medigap plans offered by various insurers in Nebraska. Which of the following statements is most accurate regarding the cost of Medigap plans in Nebraska? A. Because Medigap plans are standardized, all plans in Nebraska will have the same premium regardless of the insurer. B. While the benefits are standardized, insurers in Nebraska can set different premiums for their Medigap plans. C. The Nebraska Department of Insurance regulates Medigap premiums and ensures they are all priced identically. D. Federal law mandates that all Medigap plans have the same premium nationwide. The correct answer is B. While the benefits are standardized, insurers in Nebraska can set different premiums for their Medigap plans. Although Medigap plans are standardized by the federal government to offer the same benefits under each plan type, e.g., Plan A, Plan G, insurers in Nebraska have some flexibility in setting their premiums for these plans. This means Ms. Brown can compare rates from different insurers offering the same Medigap plan, like Plan G, to find the most affordable option for her needs. Question 72. Mr. Lopez is a life insurance agent licensed in Nebraska and is explaining life insurance policy contestability to a client. According to Nebraska insurance law, what is the typical contestability period for a life insurance policy? A. Life insurance policies in Nebraska are contestable for the entire lifetime of the insured. B. The contestability period in Nebraska varies depending on the policy type and face amount. C. Life insurance policies in Nebraska are generally contestable for 2 years after the policy is issued. D. There is no contestability period for life insurance policies in Nebraska. The correct answer is C. Life insurance policies in Nebraska are generally contestable for 2 years after the policy is issued. Nebraska follows a standard contestability clause for life insurance policies. This clause allows the insurer to contest the validity of the policy, potentially denying a death benefit, within a specific timeframe after the policy is issued. This period is typically 2 years from the policy issue date. During this time, the insurer can investigate the application for misrepresentation or material omissions of information. After the contestability period expires, the insurer's ability to contest the policy based on these factors is generally limited. Question 73. A consumer in Nebraska is considering purchasing a cancer insurance policy. They are concerned about the definition of cancer used by different insurance companies. According to Nebraska insurance regulations, what can consumers do to ensure they understand how cancer is defined in a cancer insurance policy? A. There is a mandated definition of cancer used by all insurers offering cancer insurance in Nebraska. B. Nebraska requires insurers to disclose their definition of cancer in clear and concise language within the policy. C. Consumers in Nebraska should rely solely on the agent's explanation of the cancer definition. D. Cancer insurance policies in Nebraska are not subject to any specific definition requirements. The correct answer is B. Nebraska requires insurers to disclose their definition of cancer in clear and concise language within the policy. Nebraska insurance regulations do not mandate a single, universal definition of cancer for insurance purposes. However, they do require insurers to clearly and concisely define what constitutes cancer within the policy itself. This allows consumers to understand what types of conditions are covered by the policy and avoid potential coverage surprises. It's important for consumers to carefully review the policy definition of cancer, not solely rely on the agent's explanation, to ensure they are getting the coverage they expect. Question 74. Ms. Clark is a resident of Kearney, Nebraska, and is considering applying for a health insurance policy. She has a pre-existing medical condition and is concerned about being denied coverage. According to the Affordable Care Act, ACA, what protections are available to Ms. Clark regarding pre-existing conditions and health insurance coverage in Nebraska? A. The ACA prohibits health insurance companies in Nebraska from denying coverage based solely on pre-existing conditions. B. The ACA allows insurers in Nebraska to deny coverage or charge higher premiums based on pre-existing conditions, but only for a limited time. C. The ACA has no impact on pre-existing condition underwriting in Nebraska. State laws govern these practices. D. The ACA only applies to employer-sponsored health plans in Nebraska, not individual plans. The correct answer is A. The ACA prohibits health insurance companies in Nebraska from denying coverage based solely on pre-existing conditions. One of the key provisions of the ACA is the prohibition on denying coverage or charging higher premiums based solely on pre-existing conditions. This applies to all qualified health plans offered on the individual and small group markets, regardless of location. Therefore, Ms. Clark cannot be denied coverage by a qualified health plan in Nebraska due to her pre-existing condition. Question 75. Mr. Edwards is a life insurance agent working in Omaha, Nebraska. He is explaining policy replacement to a client who is considering replacing their existing life insurance policy with a new one. Nebraska law requires a replacement notice to be delivered to the policyholder. What information must be included in this replacement notice according to Nebraska regulations? A. A detailed comparison of the benefits and features of both the existing and new life insurance policies. B. A justification for why the agent recommends replacing the existing policy. C. The contact information of the existing insurer and the option to decline the replacement. D. A copy of the application for the new life insurance policy. The correct answer is C. The contact information of the existing insurer and the option to decline the replacement. Nebraska replacement life insurance laws mandate that a replacement notice be provided to the policyholder at least 10 days before submitting an application for a new policy. This notice should disclose the right to decline the replacement and continue with the existing policy. It should also include the contact information of the existing insurer, allowing the policyholder to directly communicate with them if needed. While a detailed comparison of both policies might be helpful for the client, it's not mandatory under Nebraska replacement notice requirements. The agent's justification for replacement is also not required in the notice itself. Question 76. A consumer in Nebraska is interested in purchasing a disability income insurance policy. They are unsure how long benefits will continue if they become disabled. According to Nebraska insurance regulations, are there any limitations on the benefit period for disability income insurance policies? A. Disability income benefits in Nebraska must continue until the policyholder reaches retirement age. B. There are no limitations on the benefit period for disability income insurance in Nebraska. C. The benefit period for disability income insurance in Nebraska is typically capped at 2 years. D. The maximum benefit period for disability income insurance is determined by the Social Security Administration in Nebraska. The correct answer is D. The maximum benefit period for disability income insurance is determined by the Social Security Administration in Nebraska. Nebraska insurance regulations do not set a specific maximum benefit period for disability income insurance policies. The benefit period is typically defined within the policy itself and can vary depending on the specific plan design. Some common benefit periods might be 2 years, 5 years, or until age 65, considered retirement age for some plans. It's important for consumers to understand the specific benefit period limitations outlined in the policy they are considering. The Social Security Administration does not dictate benefit periods for private disability insurance policies sold in Nebraska. Question 77. Ms. Hernandez is a resident of Scottsbluff, Nebraska, and is considering purchasing a long-term care insurance policy. She is concerned about the potential for inflation eroding the value of her benefits over time. Which of the following statements is most accurate regarding inflation protection riders on long-term care insurance policies in Nebraska? A. All long-term care insurance policies sold in Nebraska are required to include an inflation protection rider. B. Inflation protection riders are optional on long-term care insurance policies in Nebraska, but they can significantly increase the premium cost. C. Inflation protection riders are prohibited on long-term care insurance policies sold in Nebraska. D. The Nebraska Department of Insurance regulates the benefit increases provided by inflation protection riders. The correct answer is B. Inflation protection riders are optional on long-term care insurance policies in Nebraska, but they can significantly increase the premium cost. Inflation protection riders are optional add-ons to long-term care insurance policies in Nebraska. These riders automatically increase the benefit amount over time to help offset the effects of inflation. While this feature can be valuable, it typically comes at an additional cost, increasing the overall premium for the policy. Ms. Hernandez should carefully consider the cost-benefit analysis of adding an inflation protection rider to her long-term care insurance plan. Question 78. Mr. Jackson is a life insurance agent licensed in Nebraska and is explaining insurable interest to a client. According to Nebraska law, can a business have an insurable interest in the life of a key employee? A. No. A business in Nebraska cannot have an insurable interest in the life of an employee. B. A business in Nebraska can only have an insurable interest in the life of a majority shareholder. C. Yes. A business in Nebraska can have an insurable interest in the life of a key employee if the employee's death would cause financial loss to the business. D. Nebraska law does not address insurable interest for life insurance policies on employees. The correct answer is C. Yes, a business in Nebraska can have an insurable interest in the life of a key employee if the employee's death would cause financial loss to the business. Insurable interest is a legal concept that ensures someone has a legitimate reason to purchase life insurance on another person's life. In Nebraska, businesses can have an insurable interest in the life of a key employee. This means the business can suffer a financial hardship if the employee dies. For example, a key salesperson's death could result in lost revenue, justifying the business having an insurable interest. Question 79. A consumer in Nebraska is considering purchasing a health insurance policy with a high-deductible health plan, HDHP. They are also interested in contributing to a health savings account, HSA, to offset the higher out-of-pocket costs associated with the HDHP. According to Nebraska regulations, what is the minimum deductible amount required for an HDHP to qualify for contributions to an HSA? A. Nebraska does not have a minimum deductible requirement for HDHPs to qualify for HSAs. B. The minimum deductible amount for HDHP HSA eligibility in Nebraska is set by the individual health insurance plan. C. The IRS establishes the minimum deductible requirement for HDHPs to qualify for HSA contributions nationwide, including Nebraska. D. There is no minimum deductible requirement, but the maximum out-of-pocket limit for HDHPs must be within a specific range in Nebraska. The correct answer is C. The IRS establishes the minimum deductible requirement for HDHPs to qualify for HSA contributions nationwide, including Nebraska. The Internal Revenue Service, IRS, sets the minimum annual deductible amounts for HDHPs to qualify for contributions to HSAs. These minimum deductible requirements apply nationwide, including Nebraska. Consumers should consult the latest IRS guidelines to confirm the specific minimum deductible amounts for the current tax year. While Nebraska may regulate other aspects of health insurance plans, the minimum deductible for HSA eligibility is established by federal law. Question 80. Ms. Lee is a resident of Hastings, Nebraska, and is considering applying for a Medicare Supplement Insurance Policy, Medigap. She is aware of the different standardized Medigap plans available, e.g., Plan G, Plan N. However, she is also interested in additional benefits beyond what a standardized Medigap plan typically covers. According to Nebraska insurance regulations, what options are available to Ms. Lee if she wants coverage beyond a standardized Medigap plan? A. Ms. Lee cannot purchase any additional insurance beyond a standardized Medigap plan in Nebraska. B. She can purchase a Medigap plan and a separate, non-standardized supplemental health insurance policy in Nebraska, subject to underwriting approval. C. Insurers in Nebraska can offer customized Medigap plans with additional benefits, but these plans may not be guaranteed renewable. D. There are no options for additional coverage beyond a standardized Medigap plan in Nebraska. The correct answer is B. She can purchase a Medigap plan and a separate, non-standardized supplemental health insurance policy in Nebraska, subject to underwriting approval. While Nebraska adheres to standardized Medigap plans, Plan A, Plan G, etc., it allows for additional health insurance coverage beyond these plans. Ms. Lee can explore purchasing a separate, non-standardized supplemental health insurance policy alongside her Medigap plan. These supplemental plans can offer benefits that fill gaps in coverage not addressed by her Medigap plan. However, it's important to note that these supplemental plans are not standardized and may be subject to underwriting approval by the insurer, meaning they can deny coverage or charge higher premiums based on her health history. Question 81. Mr. Garcia is a life insurance agent working in Lincoln, Nebraska. He is presenting different life insurance products to a client. The client is interested in a policy that accumulates cash value over time. Which of the following life insurance products typically accumulates cash value? A. Term life insurance. B. Whole life insurance. C. Universal life insurance, variable. D. All of the above. The correct answer is D. All of the above. Out of the life insurance products listed, all of them can accumulate cash value over time. Whole life insurance. This is a permanent life insurance policy with a guaranteed death benefit and a cash value component. The cash value grows over time through accumulated premiums and credited interest. Universal life insurance. This type of permanent life insurance also offers a death benefit and cash value accumulation. However, unlike whole life, universal life policies offer flexibility in premium payments and death benefit amounts. The cash value grows based on credited interest rates and can be influenced by investment performance in certain universal life variations. Variable universal life insurance. This is a type of universal life insurance where the cash value is invested in subaccounts linked to the market. The cash value growth potential is higher than traditional universal life, but it also carries investment risk. It's important for Mr. Garcia to explain the differences in cash value accumulation rates and features between these products to help his client choose the most suitable option. Question 82. A consumer in Nebraska is considering purchasing a critical illness insurance policy. They are concerned about the financial burden of a critical illness and want a policy that will provide a lump sum cash benefit upon diagnosis. However, they are unsure if their pre-existing medical conditions would exclude them from coverage. According to Nebraska insurance regulations, how can pre-existing conditions impact critical illness insurance applications? A. Insurers in Nebraska cannot deny coverage based solely on pre-existing conditions for critical illness insurance. B. Critical illness insurance policies in Nebraska are guaranteed issue, meaning pre-existing conditions cannot affect coverage. C. Pre-existing conditions can be used for denial of coverage or limitations on benefits in critical illness insurance policies sold in Nebraska. D. The impact of pre-existing conditions on critical illness insurance in Nebraska depends on the severity of the condition. The correct answer is C. Pre-existing conditions can be used for denial of coverage or limitations on benefits in critical illness insurance policies sold in Nebraska. Critical illness insurance is not guaranteed issue in Nebraska. This means insurers have the right to consider pre-existing medical conditions when evaluating applications. They can deny coverage entirely, exclude specific critical illnesses from coverage based on pre-existing conditions, or even limit the benefit payout amount. Consumers should carefully review the policy details, particularly the exclusions related to pre-existing conditions, to understand how their health history might impact their coverage. Question 83. Ms. Johnson is a resident of Grand Island, Nebraska, and is considering applying for a disability income insurance policy. She is an accountant and works from home. While not physically demanding, her job requires her to focus and analyze complex financial data for extended periods. Ms. Johnson is concerned about qualifying for disability benefits if she experiences a mental health condition that affects her ability to concentrate. According to Nebraska insurance regulations, how do mental health conditions typically factor into disability income insurance coverage? A. Mental health conditions are automatically excluded from coverage in all disability income insurance policies sold in Nebraska. B. Disability income benefits for mental health conditions are limited to a specific time frame in Nebraska. C. Mental health conditions can be covered under disability income insurance in Nebraska, but the specific details depend on the policy definition of disability. D. There are no regulations in Nebraska regarding how mental health conditions are addressed in disability income insurance policies. The correct answer is C. Mental health conditions can be covered under disability income insurance in Nebraska, but the specific details depend on the policy definition of disability. Nebraska does not mandate specific exclusions for mental health conditions in disability income insurance policies. However, the coverage for mental health conditions depends on the policy's definition of disability. Some policies may define disability based on a functional limitation, meaning the inability to perform the essential duties of your occupation. If Ms. Johnson's mental health condition prevents her from concentrating and fulfilling her job responsibilities as an accountant, she might qualify for benefits under such a definition. It's crucial for Ms. Johnson to carefully review the policy definition of disability and any exclusions related to mental health conditions to understand her potential coverage. Question 84. Mr. Anderson is a life insurance agent licensed in Nebraska and is explaining policy lapses to a client. According to Nebraska law, what is typically required to reinstate a lapsed life insurance policy? A. Reinstatement of a lapsed life insurance policy in Nebraska only requires payment of past due premiums. B. In addition to past due premiums, reinstatement in Nebraska may require evidence of insurability, depending on the time elapsed since lapse. C. Life insurance policies in Nebraska cannot be reinstated after they lapse. D. The requirements for reinstatement are determined by the life insurance agent and are not subject to any regulations. The correct answer is B. In addition to past due premiums, reinstatement in Nebraska may require evidence of insurability, depending on the time elapsed since lapse. Life insurance policies in Nebraska typically can be reinstated after a lapse, but the process may involve more than just paying the missed premiums. Nebraska allows insurers to require evidence of insurability, particularly if a significant amount of time has passed since the lapse. This evidence, often in the form of a medical questionnaire or health exam, helps the insurer assess the applicant's current health status and determine the risk associated with reinstating the policy. Mr. Anderson should explain these reinstatement requirements to his client to ensure they understand the process involved. Question 85. A consumer in Nebraska is considering purchasing a long-term care insurance policy. They are concerned about the possibility of premium increases after the policy is issued. According to Nebraska insurance regulations, can long-term care insurance premiums be increased after the policy is issued? A. No. Long-term care insurance premiums in Nebraska cannot be increased after the policy is issued. B. Long-term care insurance premiums in Nebraska can be increased at any time by the insurer. C. Guaranteed renewable long-term care insurance policies in Nebraska cannot have premium increases unless approved by the Nebraska Department of Insurance. D. There are no regulations in Nebraska regarding premium increases for long-term care insurance policies. The correct answer is C. Guaranteed renewable long-term care insurance policies in Nebraska cannot have premium increases unless approved by the Nebraska Department of Insurance. Nebraska insurance regulations differentiate between guaranteed renewable and non-guaranteed renewable long-term care insurance policies. Guaranteed renewable policies offer the security of knowing the premium cannot be increased by the insurer unless approved by the Nebraska Department of Insurance. This approval process helps ensure any premium increases are justified and reasonable. Non-guaranteed renewable policies, on the other hand, allow the insurer more flexibility to raise premiums in the future. Consumers should carefully consider the type of long-term care insurance policy they are purchasing and understand the potential for future premium increases. Question 86. Ms. Hernandez is a resident of Beatrice, Nebraska, and is considering applying for health insurance. She recently graduated from college and is currently unemployed. Ms. Hernandez can potentially qualify for coverage under a specific federal program. Which of the following programs is most likely to provide health insurance coverage for Ms. Hernandez in her current situation? A. Medicare. B. Medicaid. C. COBRA, Consolidated Omnibus Budget Reconciliation Act. D. Employer-sponsored health insurance. The correct answer is B. Medicaid. Medicare is typically for individuals aged 65 and over or those with qualifying disabilities. Ms. Hernandez is likely not eligible for Medicare yet. Medicaid is a joint federal and state program that provides health coverage for low-income individuals and families. Since Ms. Hernandez is recently unemployed, she may qualify for Medicaid coverage in Nebraska based on her income. COBRA allows continuation of coverage under an employer's group health plan for a limited time after a qualifying event, like job loss. However, Ms. Hernandez may not have had previous employer-sponsored coverage to qualify for COBRA. Employer-sponsored health insurance requires current employment with a company that offers health insurance benefits. Question 87. Mr. Jackson is a life insurance agent working in Omaha, Nebraska. He is explaining riders to a client who is interested in adding additional benefits to their existing life insurance policy. One rider option is a waiver of premium rider. What does a waiver of premium rider typically do for a life insurance policy? A. It waives the requirement for a medical exam when applying for additional coverage. B. It waives a portion of the death benefit payout to the beneficiary in exchange for a lower premium. C. It waives future premium payments if the insured becomes disabled and meets the rider's definition of disability. D. It waives any tax implications associated with the death benefit payout. The correct answer is C. It waives future premium payments if the insured becomes disabled and meets the rider's definition of disability. A waiver of premium rider is an optional add-on to a life insurance policy. If the insured becomes disabled according to the specific definition outlined in the rider waives the requirement to pay future premiums. This helps ensure the policy remains active and the death benefit remains in place even if the insured can no longer afford the premiums due to disability. Question 88. A consumer in Nebraska is considering purchasing a health insurance policy with a high-deductible health plan, HDHP. They are also interested in contributing to a health savings account, HSA, to offset the higher out-of-pocket costs associated with the HDHP. However, they are unsure if they can use HSA funds to pay for health insurance premiums. A. HSA funds can be used to pay for health insurance premiums in Nebraska, regardless of the plan type. B. HSA funds can only be used to pay for qualified medical expenses, not health insurance premiums in Nebraska. C. HSA funds can be used to pay for premiums on HDHPs but not other health insurance plan types in Nebraska. D. The use of HSA funds for premiums depends on the specific HSA administrator and their rules. The correct answer is B. HSA funds can only be used to pay for qualified medical expenses, not health insurance premiums in Nebraska. HSA funds are intended for qualified medical expenses, which typically include deductibles, copayments, coinsurance, and some preventive care services. In Nebraska, HSA funds cannot be used to pay for health insurance premiums, regardless of the plan type, HDHP or otherwise. There may be some flexibility depending on the specific HSA administrator, but generally, premiums are not considered qualified medical expenses under HSA regulations. Question 89. Ms. Lee is a resident of Fremont, Nebraska, and is considering applying for a Medicare supplement insurance policy, Medigap. She understands that Medigap plans help cover some of the out-of-pocket expenses associated with original Medicare, Parts A and B. Ms. Lee is also interested in coverage for prescription drugs. Which of the following options accurately describes how Ms. Lee can obtain prescription drug coverage? A. Some Medigap plans, like Plan F, include prescription drug coverage in Nebraska. B. Ms. Lee can purchase a separate Medicare Part D prescription drug plan in addition to her Medigap plan in Nebraska. C. Original Medicare, Parts A and B, automatically covers prescription drugs in Nebraska. D. Prescription drug coverage is not available for Medicare beneficiaries in Nebraska. The correct answer is B. Ms. Lee can purchase a separate Medicare Part D prescription drug plan in addition to her Medigap plan in Nebraska. Original Medicare, Parts A and B, does not cover prescription drugs. To obtain prescription drug coverage, Ms. Lee has two options in Nebraska. Medigap plans. While some Medigap plans, like Plans F and G before 2020, historically offered some limited prescription drug coverage, new regulations prevent new Medigap plans from including this benefit. Therefore, a standard Medigap plan purchased today will not cover prescription drugs. Medicare Part D. This is a separate federal program offering prescription drug coverage to Medicare beneficiaries. Individuals can enroll in a standalone Part D plan offered by private insurance companies or explore Medicare Advantage plans, Part C, that often include prescription drug coverage alongside other benefits. Question 90. Mr. Garcia is a life insurance agent licensed in Lincoln, Nebraska. He is presenting different life insurance products to a client. The client is interested in a policy that offers lifetime guaranteed level premiums. Which of the following life insurance products typically has guaranteed level premiums? A. Term life insurance. B. Variable universal life insurance. C. Whole life insurance. D. None of the above. The correct answer is C. Whole life insurance. Out of the life insurance products listed, whole life insurance typically offers guaranteed level premiums. These premiums remain constant throughout the entire policy, regardless of the insured's age or changing health status. Term life insurance. Premiums typically increase as the insured ages and the risk of death increases. Universal life insurance. Premiums can be flexible, but they are not guaranteed to remain level throughout the policy. Variable universal life insurance. Similar to universal life, premiums are not guaranteed and can fluctuate based on the performance of the underlying investment subaccounts. Mr. Garcia should explain the premium structure of each life insurance product to help his client choose the option that best aligns with their budget and needs. Question 91. A consumer in Nebraska is considering purchasing a cancer insurance policy. They are concerned about the claims process and wonder how long it typically takes to receive a benefit payout after a cancer diagnosis. A. Nebraska law mandates a specific time frame for insurers to process and pay out cancer insurance claims. B. The claims payout timeframe for cancer insurance in Nebraska depends on the severity of the cancer diagnosis. C. The claims process for cancer insurance is standardized nationwide, with a set timeframe for payouts. D. The timeframe for receiving a cancer insurance benefit payout depends on the specific policy provisions and the insurer's claims processing procedures. The correct answer is D. The timeframe for receiving a cancer insurance benefit payout depends on the specific policy provisions and the insurer's claims processing procedures. There is no mandated timeframe for cancer insurance claim payouts in Nebraska. The specific timeframe depends on several factors outlined in the policy itself, such as claim definition. The policy will define what constitutes a covered cancer diagnosis and the specific events that trigger a benefit payout. Claims submission process. The policy will detail the required documentation and steps for filing a claim. Insurer's claims processing procedures. Each insurer has its own internal procedures for reviewing and processing claims. It's important for the consumer to carefully review the policy details regarding the claims process and timelines. They should also contact the insurer directly to understand their typical turnaround times for processing cancer insurance claims. Question 92. Ms. Johnson is a resident of Grand Island, Nebraska, and recently purchased a new individual health insurance plan. She is concerned about the potential for the insurer to rescind her policy, meaning canceling it after it has been issued. According to Nebraska insurance regulations, what is the typical time frame for an insurer to rescind a health insurance policy due to misrepresentation on the application? A. An insurer in Nebraska can rescind a health insurance policy for misrepresentation at any time. B. Nebraska law allows rescission of a health insurance policy only if the misrepresentation is material and occurs within the first 2 years of the policy. C. Health insurance policies in Nebraska cannot be rescinded due to misrepresentation on the application. D. The time frame for rescission based on misrepresentation depends on the severity of the misrepresented information. The correct answer is B. Nebraska law allows rescission of a health insurance policy only if the misrepresentation is material and occurs within the first 2 years of the policy. Nebraska follows a 2-year contestable period for health insurance policies. This means the insurer has 2 years from the policy issue date to investigate the application for misrepresentation. If a material misrepresentation, false or misleading information that affects the insurer's decision to offer coverage or the premium rate, is found within this timeframe, the insurer can rescind the policy. After 2 years, the policy becomes incontestable for misrepresentation, and the insurer generally cannot cancel it based on information on the application. Question 93. Mr. Anderson is a life insurance agent licensed in Omaha, Nebraska. He is explaining beneficiary designations to a client. The client wants their spouse to be the primary beneficiary but also wants to ensure a portion of the death benefit goes to their children if the spouse predeceases them. How can Mr. Anderson help the client achieve this outcome? A. Mr. Anderson can designate the spouse as the primary beneficiary and include a contingent beneficiary designation for the children. B. The client can create a separate life insurance policy with the children named as the beneficiaries. C. Life insurance policies in Nebraska do not allow for contingent beneficiaries. D. Mr. Anderson cannot advise on beneficiary designations. This is a legal matter. The correct answer is A. Mr. Anderson can designate the spouse as the primary beneficiary and include a contingent beneficiary designation for the children. Beneficiary designations allow the policyholder to specify who will receive the death benefit. Mr. Anderson can help the client designate their spouse as the primary beneficiary. He can then add a contingent beneficiary designation naming their children. If the spouse is still living when the insured dies, the spouse receives the entire death benefit. However, if the spouse predeceases the insured, the death benefit will pass to the named children as contingent beneficiaries. Question 94. A consumer in Nebraska is considering purchasing a long-term care insurance policy. They are concerned about the possibility of being denied coverage due to their age. According to Nebraska insurance regulations, is there a maximum age limit for applying for long-term care insurance in Nebraska? A. There is a maximum age limit for purchasing long-term care insurance in Nebraska. B. Nebraska insurance regulations do not set a maximum age limit for long-term care insurance applications. C. While there is no set age limit, insurers in Nebraska may be more likely to deny coverage or charge higher premiums for applicants above a certain age. D. Consumers must be Medicare eligible to apply for long-term care insurance in Nebraska. The correct answer is B. Nebraska insurance regulations do not set a maximum age limit for long-term care insurance applications. Nebraska insurance regulations do not establish a cutoff age for applying for long-term care insurance. Consumers of any age can apply. However, it's important to understand that age is a significant factor considered by insurers when evaluating applications. As age increases, the risk of needing long-term care services also increases. This can make it more likely for insurers to deny coverage or charge higher premiums for older applicants. Question 95. Ms. Hernandez is a resident of Beatrice, Nebraska, and is considering applying for health insurance. She is self-employed and does not have access to employer-sponsored health insurance. Ms. Hernandez can potentially qualify for coverage under a specific federal program designed to help bridge the gap in health insurance coverage. Which of the following programs is most likely to provide health insurance coverage for Ms. Hernandez in her situation? A. Medicare. B. Medicaid. C. CHAMPA, Civilian Health and Medical Program of the Department of Veterans Affairs. D. The Marketplace, ACA Individual Health Insurance Marketplace. The correct answer is D. The Marketplace, ACA Individual Health Insurance Marketplace. Medicare is typically for individuals aged 65 and over or those with qualifying disabilities. Ms. Hernandez likely does not qualify for Medicare yet. Medicaid is a joint federal and state program that provides health coverage for low-income individuals and families. While Ms. Hernandez may qualify based on income, her self-employed status might not meet all eligibility requirements. CHAMPVA is a program that provides healthcare benefits to certain family members of veterans. Since Ms. Hernandez is self-employed, she likely doesn't qualify for this program. The Marketplace, also referred to as the Affordable Care Act, ACA, Individual Health Insurance Marketplace, is a resource for individuals to shop for and enroll in private health insurance plans. This program is most suitable for Ms. Hernandez's situation as a self-employed person seeking individual health insurance coverage. The Marketplace also offers subsidies to help make premiums more affordable for qualifying individuals and families. Question 96. Mr. Jackson is a life insurance agent working in Omaha, Nebraska. He is explaining grace periods to a client who has recently missed a premium payment on their life insurance policy. The grace period allows the policyholder some extra time to make the payment before the policy lapses. According to Nebraska insurance regulations, what is the typical grace period for most life insurance policies sold in Nebraska? A. 10 days. B. 30 days. C. 60 days. D. The grace period is determined by the life insurance agent and is not mandated by the state. The correct answer is B. 30 days. Nebraska law mandates a minimum grace period of 30 days for most life insurance policies sold in the state. This grace period allows the policyholder some extra time to make a missed premium payment before the policy lapses and the coverage is terminated. Some life insurance policies may offer a longer grace period than the state minimum, but 30 days is the standard timeframe. Question 97. A consumer in Nebraska is considering purchasing a critical illness insurance policy. They are unsure if their policy would pay a benefit if they are diagnosed with a critical illness but do not require hospitalization. According to Nebraska insurance regulations, how do critical illness insurance policies typically define a covered critical illness? A. Critical illness policies in Nebraska only cover illnesses that require hospitalization. B. The definition of a covered critical illness can vary depending on the specific policy provisions. C. Nebraska mandates a standardized definition of covered critical illnesses for all critical illness insurance policies. D. Critical illness insurance policies only cover cancers diagnosed at an advanced stage. The correct answer is B. The definition of a covered critical illness can vary depending on the specific policy provisions. Nebraska does not enforce a standardized definition of covered critical illnesses for critical illness insurance policies. The specific illnesses covered and the requirements to trigger a benefit payout will vary depending on the policy language. Some policies may require hospitalization as part of the illness definition, while others may focus on diagnosis alone. It's crucial for the consumer to carefully review the policy details, particularly the definition of covered critical illnesses and the benefit payout triggers, to understand what their specific policy covers. Question 98. Ms. Lee is a resident of Fremont, Nebraska, and recently purchased a health insurance plan through the Marketplace, ACA Individual Health Insurance Marketplace. She is unhappy with the plan's network of doctors and is considering switching plans during the next open enrollment period. When is the open enrollment period typically held in Nebraska? A. Open enrollment for the Marketplace is year-round in Nebraska. B. Open enrollment typically occurs once a quarter in Nebraska. C. There is a specific open enrollment period each year, and missing it may limit Ms. Lee's options for switching plans. D. Open enrollment depends on the specific health insurance plan Ms. Lee selected. The correct answer is C. There is a specific open enrollment period each year, and missing it may limit Ms. Lee's options for switching plans. The open enrollment period is a designated timeframe each year when individuals can enroll in or switch plans through the Marketplace. Missing this window typically limits consumers to qualifying events, like job loss or marriage, to make changes to their Marketplace health insurance coverage outside of open enrollment. Ms. Lee should research the specific open enrollment dates for the upcoming year to determine when she can switch plans and potentially find a new plan with a doctor network that better suits her needs. Question 99. Mr. Garcia is a life insurance agent licensed in Lincoln, Nebraska. A client inquires about universal life insurance and wants to know if there are any tax advantages associated with this type of policy. How should Mr. Garcia respond regarding the tax treatment of universal life insurance in Nebraska? A. Premiums paid on universal life insurance are tax-deductible in Nebraska. B. Death benefits from universal life insurance are always taxed in Nebraska. C. Universal life insurance cash value grows tax-deferred in Nebraska, but withdrawals may be taxed. D. There are no tax benefits associated with universal life insurance in Nebraska. The correct answer is C. Universal life insurance cash value grows tax-deferred in Nebraska, but withdrawals may be taxed. Universal life insurance offers features not typically found in traditional whole life insurance. One key benefit is the accumulation of cash value. In Nebraska, as with most states, premiums paid on universal life insurance are not tax-deductible. However, the cash value within the policy grows on a tax-deferred basis. This means any earnings on the cash value are not taxed until they are withdrawn. It's important to note that withdrawals from the cash value may be subject to income taxes if they exceed the amount of premium paid into the policy. Mr. Garcia should explain these tax implications to his client when discussing universal life insurance. Question 100. A consumer in Nebraska is considering purchasing a disability income insurance policy. They are unsure if the policy would pay benefits if they are unable to work in their current profession due to a disability but could potentially find work in a different field with less demanding requirements. According to Nebraska insurance regulations, how do disability income insurance policies typically define disability? A. Disability income benefits are only payable if the insured is completely unable to perform any type of work. B. The definition of disability can vary depending on the specific policy provisions. C. Nebraska mandates a standardized definition of disability for all disability income insurance policies. D. Disability income benefits are payable if the insured can only work part-time due to a disability. The correct answer is B. The definition of disability can vary depending on the specific policy provisions. Nebraska does not require a standardized definition of disability for disability income insurance policies. The specific definition and the conditions for receiving benefits will vary depending on the wording within the policy itself. There are two common disability definitions used. Own occupation definition. This pays benefits if the insured cannot perform the duties of their specific occupation due to a disability. Any occupation definition. This has a stricter requirement, only paying benefits if the insured cannot perform any work for which they are qualified or suited due to a disability. The consumer should carefully review the policy definition of disability to understand the specific criteria for receiving benefits if they become disabled. Question 101. Ms. Johnson is a resident of Grand Island, Nebraska, and is expecting her first child. She wants to ensure her health insurance plan covers maternity services. When can Ms. Johnson typically add maternity coverage to her existing health insurance plan in Nebraska? A. Maternity coverage can be added to a Nebraska health insurance plan at any time. B. Ms. Johnson can add maternity coverage during her open enrollment period. C. Adding maternity coverage is only possible during a qualifying event, like pregnancy, in Nebraska. D. Maternity coverage is automatically included in all health insurance plans sold in Nebraska. The correct answer is C. Adding maternity coverage is only possible during a qualifying event, like pregnancy, in Nebraska. Generally, adding maternity coverage to an existing health insurance plan outside of open enrollment is only possible during a qualifying event. Pregnancy is a qualifying event in Nebraska, allowing Ms. Johnson to add maternity coverage to her plan. However, there may be specific enrollment deadlines associated with adding coverage during a qualifying event. Ms. Johnson should contact her insurance company to inquire about the process and deadlines for adding maternity coverage to her plan due to her pregnancy. Question 102. Mr. Anderson is a life insurance agent licensed in Omaha, Nebraska. A client inquires about whole life insurance and wants to know if there are any loan options associated with this type of policy. How should Mr. Anderson respond regarding policy loans on whole life insurance in Nebraska? A. Whole life insurance policies in Nebraska cannot be used for loans. B. Policy loans on whole life insurance are treated as taxable income in Nebraska. C. Whole life insurance policies typically accumulate a cash value that can be borrowed against with interest in Nebraska. D. Mr. Anderson cannot advise on policy loans. This is a financial matter. The correct answer is C. Whole life insurance policies typically accumulate a cash value that can be borrowed against with interest in Nebraska. One of the key features of whole life insurance is the accumulation of cash value over time. Policyholders in Nebraska, as in most states, can typically borrow against this cash value. The borrowed funds are subject to interest, and the outstanding loan amount is deducted from the death benefit payout. Mr. Anderson should explain these details and the implications of policy loans to his client considering whole life insurance. Question 103. A consumer in Nebraska is considering purchasing a Medicare supplement insurance policy, Medigap. They are concerned about standardized Medigap plans and wonder if all Medigap plans offer the same coverage. A. All Medigap plans offered in Nebraska are standardized and provide identical coverage. B. There are different standardized Medigap plans, Plan A, Plan F, etc., in Nebraska, each with varying coverage options. C. Standardized Medigap plans are not available in Nebraska. Medigap plans can vary greatly in coverage and cost. D. The consumer should choose the cheapest Medigap plan in Nebraska, regardless of the coverage details. The correct answer is B. There are different standardized Medigap plans, Plan A, Plan F, etc., in Nebraska, each with varying coverage options. Nebraska follows the standardized Medigap system. This means Medigap plans are categorized by lettered names, Plan A, Plan F, etc., and each plan type offers a standardized set of benefits. Consumers can choose the specific Medigap plan that best suits their needs and budget based on the coverage provided by each plan type. It's important to note that some Medigap plans, like Plan F, have undergone changes to limit coverage for certain expenses, so not all previously available benefits may be included in every plan. Question 104. Ms. Hernandez is a resident of Beatrice, Nebraska, and recently purchased a new individual health insurance plan. She is concerned about the network of doctors covered by her plan. Can Ms. Hernandez see any doctor she chooses, regardless of their participation in her plan's network? A. Ms. Hernandez can see any doctor she chooses, but she may be responsible for a higher percentage of the cost. B. In-network doctors typically offer the most affordable coverage under most health insurance plans in Nebraska. C. Ms. Hernandez is limited to seeing doctors within her plan's network in Nebraska. D. There are no restrictions on the doctors Ms. Hernandez can see. Her plan will cover all costs regardless of the provider. The correct answer is A. Ms. Hernandez can see any doctor she chooses, but she may be responsible for a higher percentage of the cost. Most health insurance plans in Nebraska, including individual plans like Ms. Hernandez's, utilize provider networks. These networks consist of doctors, hospitals, and other healthcare providers who have contracted with the insurance company to offer discounted rates for covered services. While Ms. Hernandez can choose to see any doctor she wants, seeing an out-of-network provider typically comes with higher out-of-pocket costs for the patient. In-network providers have negotiated rates with the insurance company, resulting in lower patient cost-sharing requirements like deductibles, copays, and coinsurance. Question 105. Mr. Jackson is a life insurance agent working in Omaha, Nebraska. A client inquires about term life insurance and wants to know if the policy value increases over time. How should Mr. Jackson respond regarding the cash value component of term life insurance policies? A. Term life insurance policies in Nebraska typically accumulate cash value over time. B. Term life insurance is designed to provide temporary coverage and does not accumulate cash value. C. The cash value accumulation on term life insurance policies depends on the specific plan options chosen. D. Mr. Jackson cannot advise on cash value. This is a product feature, not financial advice. The correct answer is B. Term life insurance is designed to provide temporary coverage and does not accumulate cash value. Term life insurance is a pure protection life insurance product. Unlike whole life insurance, which builds cash value, term life insurance policies are designed to provide coverage for a specific period, the term, and typically do not accumulate any cash value. The premium pays for the death benefit in case of the insured's passing within the term. If the insured survives the term, the policy expires, and no cash value is returned. Mr. Jackson should explain this key difference between term and whole life insurance to his client. Question 106. A consumer in Nebraska is considering purchasing a dental insurance plan. They want coverage for major dental procedures like crowns and root canals. When choosing a dental insurance plan, what should this consumer focus on in Nebraska? A. Focus on plans with the lowest monthly premiums, regardless of the covered services. B. The annual maximum benefit amount will determine how much the plan covers for major procedures. C. The deductible amount will significantly impact the initial out-of-pocket costs for dental services. D. All dental insurance plans in Nebraska offer comprehensive coverage for major procedures. The correct answer is B. The annual maximum benefit amount will determine how much the plan covers for major procedures. Dental insurance plans vary in coverage and cost. When choosing a plan in Nebraska, the consumer should consider their anticipated dental needs, particularly if they require major procedures like crowns or root canals. A crucial factor is the annual maximum benefit amount. This is the total dollar amount the plan will pay for covered services within a policy year. Consumers with a higher likelihood of needing major procedures should prioritize plans with higher annual maximum benefit amounts to ensure sufficient coverage for these more expensive services. Question 107. Ms. Lee is a resident of Fremont, Nebraska, and is nearing retirement age. She is considering purchasing an annuity to provide her with a guaranteed income stream in retirement. What are some of the key features Ms. Lee should consider when evaluating different annuity options in Nebraska? A. Annuity taxation is the primary factor to consider when choosing an annuity in Nebraska. B. The payout options, including guaranteed income for life, are a crucial aspect to consider for retirement income planning. C. Annuity costs are not a significant factor. Ms. Lee should focus on the highest payout regardless of cost. D. Annuity surrender charges should not be a concern for Ms. Lee as she won't need to access the funds before retirement. The correct answer is B. The payout options, including guaranteed income for life, are a crucial aspect to consider for retirement income planning. Annuities can be a valuable tool for retirement income planning. Ms. Lee should carefully evaluate several key features when choosing an annuity in Nebraska. Payout options. Annuities offer various ways to receive benefits, including a lump sum, a guaranteed income stream for life, or a combination of both. Considering her goal of retirement income, Ms. Lee should prioritize payout options that provide her with a steady income stream throughout her retirement years. Taxation. Annuity taxation can vary depending on the type of annuity and how the premiums are funded. Ms. Lee should understand the tax implications of different annuity options. Costs and fees. There are various fees associated with annuities, including surrender charges, penalties for withdrawing funds before a certain time, and expense ratios, ongoing fees for managing the annuity. Ms. Lee should compare the costs and fees of different annuity options. Question 108. Mr. Garcia is a life insurance agent licensed in Lincoln, Nebraska. A client inquires about variable universal life insurance and wants to know if the cash value grows over time. How should Mr. Garcia respond regarding the cash value accumulation in variable universal life insurance? A. Variable universal life insurance policies offer guaranteed growth of the cash value in Nebraska. B. The cash value in variable universal life insurance grows based on the performance of the underlying investments. C. Variable universal life insurance policies do not accumulate cash value. D. Mr. Garcia cannot advise on cash value growth. This depends on market conditions. The correct answer is B. The cash value in variable universal life insurance grows based on the performance of the underlying investments. Variable universal life insurance combines features of term life insurance and variable annuities. Unlike traditional whole life insurance with guaranteed cash value growth, variable universal life links the cash value to the performance of investment subaccounts chosen by the policyholder. The cash value can fluctuate based on market gains or losses within these subaccounts. Mr. Garcia should explain the variable nature of the cash value and the associated risks to his client considering variable universal life insurance. Question 109. A consumer in Nebraska is considering a Medicare Advantage plan, Part C. They are concerned about switching from their current doctor to a new provider within the Medicare Advantage plan network. Does Nebraska have any regulations regarding a patient's right to choose a new doctor within a Medicare Advantage plan? A. Medicare Advantage plans in Nebraska can restrict a patient's choice of doctors within their network. B. Nebraska mandates that Medicare Advantage plans offer a minimum network size to ensure patient choice. C. Patients enrolled in Medicare Advantage plans cannot switch doctors during the plan year in Nebraska. D. There are no regulations in Nebraska regarding patient choice of doctors within a Medicare Advantage plan network. The correct answer is B. Nebraska mandates that Medicare Advantage plans offer a minimum network size to ensure patient choice. Medicare Advantage plans are offered by private insurance companies and must meet certain federal standards. In Nebraska, there are regulations regarding the adequacy of the provider network offered by Medicare Advantage plans. This ensures that patients have a reasonable choice of doctors, hospitals, and other healthcare providers within the plan's network. While patients may need to switch to an in-network doctor, they generally have some choice within the Medicare Advantage plan's network. If the consumer has concerns about their doctor choices within a specific Medicare Advantage plan, they should contact the plan directly to inquire about the network details. Question 110. Ms. Johnson is a resident of Grand Island, Nebraska, and recently purchased a long-term care insurance policy. She is concerned about the possibility of premium increases after the policy is issued. Can long-term care insurance premiums increase in Nebraska after the policy is issued? A. Long-term care insurance premiums in Nebraska are guaranteed to remain level throughout the entire policy. B. Premium increases for long-term care insurance are only allowed under specific circumstances in Nebraska. C. Long-term care insurance premiums can increase at any time after the policy is issued in Nebraska. D. Ms. Johnson should expect premium increases as she ages and her risk of needing long-term care services grows. The correct answer is B. Premium increases for long-term care insurance are only allowed under specific circumstances in Nebraska. Unlike some other insurance lines, long-term care insurance premiums in Nebraska are not guaranteed to remain level throughout the entire policy. However, Nebraska insurance regulations do provide some consumer protections regarding premium increases. Insurers can only raise premiums under specific conditions, such as if the entire class of policyholders experiences unexpected claims costs. Even with increases, Nebraska regulations may limit the amount and frequency of premium hikes. Ms. Johnson should carefully review the premium provisions within her long-term care insurance policy to understand the circumstances under which premium increases may occur. Question 111. Mr. Anderson is a life insurance agent licensed in Omaha, Nebraska. A client inquires about critical illness insurance and wants to know if the policy covers the cost of treatment for a covered illness. How should Mr. Anderson respond regarding the benefit payout for critical illness insurance in Nebraska? A. Critical illness insurance policies in Nebraska typically cover the cost of treatment for a covered illness. B. Critical illness insurance policies provide a lump sum cash benefit upon diagnosis of a covered illness, not covering treatment costs directly. C. The payout for critical illness insurance depends on the severity of the illness in Nebraska. D. Mr. Anderson cannot advise on benefits. This is a specific policy provision. The correct answer is B. Critical illness insurance policies provide a lump sum cash benefit upon diagnosis of a covered illness, not covering treatment costs directly. Critical illness insurance is not a substitute for traditional health insurance. Critical illness policies typically provide a lump sum cash benefit if the insured is diagnosed with a critical illness defined within the policy. The policyholder can use this benefit to help cover medical expenses, lost income, or other costs associated with a critical illness. Mr. Anderson should explain that critical illness insurance does not directly cover treatment costs but provides financial assistance upon diagnosis of a covered condition. Question 112. A consumer in Nebraska is considering purchasing a disability income insurance policy. They are unsure if the policy would pay benefits if they are unable to work due to a part-time job injury, even if they could still potentially work full-time in a different field. A. Disability income benefits are payable regardless of the cause of disability in Nebraska. B. The definition of disability in the policy determines if benefits are payable for a part-time job injury in Nebraska. C. Disability income insurance only covers full-time work disabilities in Nebraska. D. Benefits are only payable if the disability prevents any work activity in Nebraska. The correct answer is B. The definition of disability in the policy determines if benefits are payable for a part-time job injury in Nebraska. As discussed previously, disability income insurance policies define disability in various ways. The specific wording within the policy will determine if benefits are payable in this situation. Some policies have an own occupation definition, which pays benefits if the insured cannot perform the duties of their specific occupation due to a disability, even if they could perform a different type of work. Other policies have a stricter any occupation definition, which only pays benefits if the insured cannot perform any work for which they are qualified or suited due to a disability. The consumer should carefully review the definition of disability in the policy they are considering to understand if a part-time job injury would qualify for benefit payments. Question 113. Ms. Hernandez is a resident of Beatrice, Nebraska, and recently enrolled in a Medicare Part D prescription drug plan. She is concerned about the plan's formulary and wants to know if a specific medication is covered. How can Ms. Hernandez find out if her Medicare Part D plan covers a particular drug? A. Ms. Hernandez can call her doctor's office to inquire about the Medicare Part D formulary. B. The Medicare website, https://www.medicare.gov/, is a reliable resource to check formulary coverage for Nebraska Part D plans. C. Her insurance company or Medicare Part D plan provider will have the most up-to-date information on formulary coverage. D. There is no way to determine coverage until Ms. Hernandez tries to fill the prescription at the pharmacy. The correct answer is C. Her insurance company or Medicare Part D plan provider will have the most up-to-date information on formulary coverage. A formulary is a list of medications covered by a specific Medicare Part D plan. Ms. Hernandez can obtain the most accurate and up-to-date information on formulary coverage by contacting her insurance company or Medicare Part D plan provider directly. These resources will have access to the current formulary for her specific plan and can confirm if the medication she needs is covered. Question 114. Mr. Jackson is a life insurance agent working in Omaha, Nebraska. A client inquires about accidental death insurance and wants to know if the policy benefit is paid in addition to any other life insurance they may have. A. Accidental death benefit is deducted from any other life insurance coverage the insured has in Nebraska. B. Accidental death insurance benefits are paid separately from any other life insurance coverage. C. Accidental death benefits only apply if the cause of death is not accidental in Nebraska. D. Mr. Jackson cannot advise on benefit payouts. This depends on the specific life insurance policy. The correct answer is B. Accidental death insurance benefits are paid separately from any other life insurance coverage. Accidental death insurance is a supplemental life insurance product that pays a benefit if the insured dies as a result of an accident. This benefit is separate from any other life insurance coverage the insured may have. If Mr. Jackson's client has both accidental death insurance and a traditional life insurance policy, the beneficiary would receive the death benefit from both policies in the event of an accidental death. Question 115. A consumer in Nebraska is considering a health insurance plan with a high deductible. They are unsure if they would be responsible for the entire cost of preventive care services under the plan. Are preventive care services typically subject to the deductible in Nebraska? A. Preventive care services are always covered in full by Nebraska health insurance plans, regardless of the deductible. B. The consumer should confirm coverage details with the insurance company, but preventive care often has minimal or no cost-sharing requirements. C. Preventive care services are subject to the deductible in all Nebraska health insurance plans. D. The Affordable Care Act, ACA, requires all Nebraska health plans to cover preventive care services at no cost. The correct answer is B. The consumer should confirm coverage details with the insurance company, but preventive care often has minimal or no cost-sharing requirements. The Affordable Care Act, ACA, mandates that most health insurance plans cover a specific set of preventive care services with no out-of-pocket costs to the insured. This typically means preventive care services are not subject to the deductible. However, there may be some exceptions or variations depending on the specific plan design. The consumer should confirm the details of preventive care coverage, including any cost-sharing requirements, by reviewing the plan brochure or contacting the insurance company directly. Question 116. Ms. Lee is a resident of Fremont, Nebraska, and is considering a cancer insurance policy as a supplement to her existing health insurance. Cancer insurance policies typically pay a lump sum benefit upon diagnosis of cancer. How will the payout from a cancer insurance policy affect Ms. Lee's health insurance coverage in Nebraska? A. The payout from a cancer insurance policy will count towards Ms. Lee's health insurance deductible in Nebraska. B. Receiving a cancer insurance benefit will not affect her health insurance coverage in Nebraska. C. Ms. Lee may need to report the payout from her cancer insurance policy to her health insurance company in Nebraska. D. Cancer insurance benefits can disqualify Ms. Lee from certain government health programs in Nebraska. The correct answer is B. Receiving a cancer insurance benefit will not affect her health insurance coverage in Nebraska. Cancer insurance is a supplemental insurance product separate from traditional health insurance. The lump sum benefit paid upon a cancer diagnosis is not considered income for health insurance purposes in Nebraska. Therefore, receiving this benefit should not affect Ms. Lee's existing health insurance coverage, including her premiums or eligibility. Question 117. Mr. Garcia is a life insurance agent licensed in Lincoln, Nebraska. A client inquires about universal life insurance and wants to know if they are guaranteed to receive the full death benefit if they let the policy lapse. A. Universal life insurance policies offer a guaranteed death benefit regardless of the policy's lapse status in Nebraska. B. If a universal life insurance policy lapses in Nebraska, the death benefit may be reduced or eliminated depending on the outstanding loan amount. C. Universal life insurance policies cannot lapse in Nebraska. D. Mr. Garcia cannot advise on policy lapses. This is the responsibility of the policyholder. The correct answer is B. If a universal life insurance policy lapses in Nebraska, the death benefit may be reduced or eliminated depending on the outstanding loan amount. Universal life insurance allows policyholders to pay premiums and accumulate cash value. Unlike whole life insurance with a guaranteed no-lapse provision, universal life policies can lapse due to non-payment of premiums. In Nebraska, if a universal life policy lapses, the accumulated cash value is typically used to pay any outstanding loan amount and any remaining balance is applied towards the death benefit. This means the death benefit may be reduced or even eliminated if the outstanding loan exceeds the available cash value. Mr. Garcia should explain these lapse provisions and their impact on the death benefit to his client considering universal life insurance. Question 118. A consumer in Nebraska is considering a health insurance plan with a health savings account, HSA. HSAs allow individuals to contribute pre-tax dollars to pay for qualified medical expenses. The consumer is unsure if they can use HSA funds to pay for health insurance premiums in Nebraska. A. HSA funds can be used to pay for health insurance premiums in Nebraska, regardless of the plan type. B. HSA funds can only be used to pay for premiums on health insurance plans with HSAs in Nebraska. C. HSA funds are not for paying premiums. They are strictly for qualified medical expenses in Nebraska. D. The consumer should consult with a tax advisor regarding HSA contribution and use rules in Nebraska. The correct answer is C. HSA funds are not for paying premiums. They are strictly for qualified medical expenses in Nebraska. Health savings accounts, HSAs, are tax-advantaged accounts used in conjunction with qualified high-deductible health insurance plans. In Nebraska, HSA funds can be used to pay for qualified medical expenses, including deductibles, copays, coinsurance, and certain over-the-counter medications. However, HSA funds cannot be used to pay for health insurance premiums themselves. While HSAs offer tax advantages for qualified medical expenses, consumers should consult with a tax advisor for specific guidance on HSA contribution and use rules. XX. Question 119. Ms. Johnson is a resident of Grand Island, Nebraska, and recently purchased a critical illness insurance policy. The policy lists a specific number of days an insured must be hospitalized to qualify for a benefit payout. Ms. Johnson experiences a covered critical illness but is only hospitalized for 2 days. Will she be eligible for a benefit payout under her policy? A. Hospitalization is not required to receive a benefit payout for a critical illness in Nebraska. B. Ms. Johnson will be eligible for a benefit payout regardless of the hospitalization requirement in Nebraska. C. The hospitalization duration requirement must be met to qualify for a benefit payout under the policy. D. Ms. Johnson should contact her insurance company to inquire about exceptions to the hospitalization requirement. The correct answer is C. The hospitalization duration requirement must be met to qualify for a benefit payout under the policy. Critical illness insurance policies typically define eligibility for benefit payouts based on the diagnosis of a covered illness and may also include specific conditions. One common requirement is a minimum hospitalization stay following the diagnosis. In Ms. Johnson's case, the policy likely requires a hospitalization exceeding 2 days to qualify for a benefit payout. She would not be eligible for a benefit unless the policy includes exceptions for outpatient treatment of her specific critical illness. Question 120. Mr. Anderson is a life insurance agent licensed in Omaha, Nebraska. A client inquires about whole life insurance and wants to know if they are guaranteed to receive the cash value accumulated in the policy. A. Mr. Anderson cannot advise on cash value access. This depends on the policy provisions. B. Whole life insurance policies in Nebraska offer a guaranteed death benefit, but cash value access is not guaranteed. C. The accumulated cash value in whole life insurance is guaranteed to be paid to the policyholder or beneficiary in Nebraska. D. Whole life insurance guarantees access to the cash value at any time without surrender charges in Nebraska. The correct answer is C. The accumulated cash value in whole life insurance is guaranteed to be paid to the policyholder or beneficiary in Nebraska. One of the key features of whole life insurance is the guaranteed accumulation of cash value over time. This cash value builds from a portion of the premiums paid. In Nebraska, as in most states, whole life insurance policies guarantee that the accumulated cash value will be paid to the policyholder upon surrender of the policy or to the beneficiary upon the insured's death, less any outstanding loans. Mr. Anderson can explain to his client that whole life insurance offers guaranteed cash value accumulation and various ways to access these funds, such as policy loans or withdrawals.